the topic of today's class, which is, of course, called Basis of Assets. And the reading assignments for today's class, if you care to spend some time looking at some publications to see where I got all my information from, those are listed here on the front of your student manual. At any rate, the publications that I've derived information from or gathered information from in the effort to make the class that you're taking today come from IRIS Publication 17 as well as IRIS Publication 551, Basis of Assets, IRIS Publication 525, Taxable and Non-Taxable Income, and also IRIS Publication 15B on page 11. There's even information there about basis of stock, and really it's not even about basis of stock, it's about taxable benefits that employees receive and how they are reported, and that is an important part of cost of assets when you're looking at stock options. So let's move on to page 2 of the manual, where we begin with an introduction. Basis is the amount of after-tax cost or investment that you have in property for tax purposes. Basis is used to figure deductions you are allowed to claim for depreciation, amortization, depletion, and casualty losses. The basis of property is used to figure your gain or loss on the sale of property. When you sell a capital asset, the sale of that asset is generally reported on Schedule D. So we're going to go into a discussion of what a capital asset is. And the reason we even care what a capital asset is that if we sell a capital asset, the sale of that asset is reported on 8949 and then carries to Schedule D. Now, in the cases of personal property sold at a loss, it is the case that the sale is not reportable at all. But if you sell personal property for a profit, then it is reportable on Schedule D. And if you sell any kind of business asset, ultimately that's reportable on Schedule D as well. So let's take a look at some definitions here. Capital assets. The tax code says that all assets are capital assets except when they're not. That's my tax preparer humor. So all assets are capital assets unless they are one of the following. And this information comes from Publication 17, page 104. So all of the following assets are not capital assets if they are any of the following. Stock or inventory held for sale to customers. Accounts or notes receivable acquired in the ordinary course of a trade or business. Depreciable property used in a trade or business. Real property used in a trade or business. Copyrights. Literary, artistic, or similar property created by personal efforts or acquired from the creator under circumstances that entitle you to the creator's basis in the property. And finally, U.S. government publications, such as Pub 17, which are free. So, again, all assets are capital assets, except when they're not. And this list here is a list of assets that are not capital assets. So here is a list of what is a capital asset. And it includes personal use property such as dwellings, cars, furniture, jewelry collections, etc. Quite frankly, personal use property can even include your pet cat. And we also have investment use property, land, stock, municipal and corporate bonds, collectibles, antiques, etc. Business use property. Only certain intangible personal type properties such as goodwill or franchise, plus any net Section 1231 like-kind exchange gain from the sale of a business use asset. So what that's saying is if you have a taxable gain in a like-kind exchange, that gain is taxed as a capital gain. Cost basis of property. Your cost basis in property is usually your purchase price. However, any of the following situations can give you a different cost basis. And I see some questions coming up here. Let's see. Are items that have no monetary value still capital assets? Well, yeah, let's look at something that would have no monetary value. An old junker car. You have a junker car sitting on a lot or, a farmland. You always see these old junkers in the country, right, with grass growing up around them. It has no value, but at one point, money was paid for it, and it's still the personal property, presumably, of the owner of the land, although possibly not. Maybe it was abandoned there. But for the person who owns that asset, it is a capital asset. It's just a worthless one. And depending on the nature of that asset, It may have been depreciated because it was used in a business, in which case its depreciable basis eventually took the adjusted basis to zero. Or it was a personal asset that was used only for personal purposes, and as it devalued and over time and eventually became worthless, there's no gain or loss realized on the disposition or the abandonment of that property. But yeah, it still is a capital asset. So cost basis of property. Your cost basis in property is usually your purchase price. However, any of the following situations can give you a different cost basis. You received property as a gift. You inherited your property. You received property in exchange for services rendered. You paid transfer taxes and insurances or other closing costs upon acquisition of your property that you could not or chose not to expense. So the first one we're going to take a look at is property received as a gift, and this one's kind of a mind bender. So I'm going to give you a series of illustrations, and as we go through each illustration, I'll pop up a Q&A pod, and you can do your best job at answering each student exercise. If you have the manual printed in front of you, you can be looking at them. There will be a total of 5 that I'm going to give you. But before we go through those together, I'm going to give you an overview of how you determine the basis that you have in a gift that you have received, and then we'll go take a look at those questions. If you have received property as a gift, you must know its adjusted basis to the donor before it was given to you. In other words, the person who gave it to you, how much did they pay for it? Or if they didn't buy it, how did they acquire it? And, for example, through inheritance. And what is their basis in it, regardless of the manner in which they acquired it? That's something you need to know, because whatever their basis is going to have a determining factor on what your basis is. So if you received property as a gift, you must know its adjusted basis to the donor just before it was given to you, its fair market value at the time it was given to you, and any gift tax that was paid on it. Then apply one of the following 2 rules to calculate your gain or loss when you sell or dispose of the gift. Firstly, we look at the fair market value at the time of the gift if it is less than the donor's adjusted basis. If you receive a gift and at the time you receive the gift, the fair market value of that gift, in other words, what it's worth if you were to sell it, is less than what was paid for it by the person who gave it to you. This is what the rules are that apply in that situation. To figure a gain, your basis is the same as the donor's basis. But to figure a loss, your basis will be the fair market value of the gift on the date you received it. Now, if the fair market value at the time of the gift is equal to or greater than the donor's adjusted basis, then whether you're figuring a gain or a loss, your basis is the same as the adjusted basis to the donor. Your basis in a gift may increase or decrease because of certain adjustment items which take place after you receive the gift. These adjustment items can include allowable depreciation, casualty or theft losses, and capital improvements you make to the property after you acquire it. Note that these rules are designed to minimize the loss and maximize the gain for IRS tax purposes. Thus, if you dispose of gifted property for a price that falls between the basis and the fair market value at the time you received the gift, there is no profit or loss on the disposition. And here is the student exercises that I was promising you. And I'll open these up one at a time. So as I'm reading the problem, it's open here in front of you, and it's class exercise number 1. Jackie received a gift with a fair market value of $100 and a basis to the donor of $150. Jackie sells the gift for $180. What is going to be her profit from that sale? So think through it and give me your best shot at an answer. I'll give you about 30 seconds and I'll put up the response. Okay, it looks like everyone's given me an answer. Just about. People are changing their answers. So we've either got A as a correct answer or B as a correct answer, and A is the correct answer. Let's think about why. Let's look at what's being said here. We have a fair market value of $100 and a basis to the donor of $150. That means if we figure a gain, we're going to go with the basis of the donor. But if we figure a loss, we're going to go with the fair market value. Since she sells it at a gain, the difference is going to be 180 minus 150, and that makes A, $30, the correct answer. And I do see another question up here. Chelsea says, so rental property traded with a net profit generates capital asset existence? Well, the rental property itself, because it's a depreciable asset used in a trade or business, it's technically identified as not being a capital asset. So the IRS says a depreciable asset used in a trade or business is not a capital asset. But the weird thing is when we get into sales of assets next week, my course called Sale of Assets, we'll see that ultimately the asset that is not treated as a capital asset, when it's sold, it's not directly reported on Schedule D. And so although we would think of a rental property as a capital asset, ultimately it's different than a capital asset because when we sell it, it receives completely different tax treatment and tax reporting requirements when it's sold. If you sell your home, and let's just suppose you're in a situation where you can't exclude the gain or you can't exclude all of the gain, and so you have a taxable disposition of your house. That disposition is reported on Schedule D and Form 8949. It actually goes on Form 8949 where the sale is reported, and then it carries to Schedule D. If you were to sell that same piece of property as a rental property, that sale would actually get reported on Form 4797, and there would be calculations going on that form before the net gain or loss ultimately carries over to either Schedule D or possibly line 14. If you sold it at a loss, it would carry to line 14. So that's why the IRS goes out of its way to say that depreciable property used in trade or business is not a capital asset, but oddly enough, when you sell it, the gain is treated as capital gain in many cases. All right, and in question number 2, Henry received a gift with a fair market value of $150 and a basis to the donor of $100. He sells the gift for $80. What is his loss from the sale? So what I'm seeing here in both the first two illustrations, I've got, it looks like about 2/3 of the class getting it and about 1/3 of the class still a little behind and not quite figuring it out. So in this case, you might guess by how I'm talking that A is the correct answer, and let's see why. We have a fair market value of the gift of $150 and a basis to the donor of $100. We sell it for a loss, so we're going to use the $100 basis. 100 minus 80 is 20, and that's where we get A as the correct answer. And the next question in line, number 3. Sally received a gift with a fair market value of $120 and a basis to the donor of $80. She sells the gift for $100. What is Sally's profit or loss from the sale? So Sally receives a gift with a fair market value of $120. She doesn't get that higher basis. She goes with the basis to the donor of $80. And then when she sells the gift for $100, she does have a profit because she sold it for $20 more than the donor's basis. So the correct answer is B. Question number 4. George received a gift with a fair market value of $120 and a basis to the donor of $100. He sells the gift for $150. What is his gain from the sale? All right, and the B's have it. B is the correct answer. So let's take a look at why. Remember that we're going to go with, if we're looking at a gain, we're not going to use the fair market value on the date of the gift because there is no cost basis of $120 to the donor. We can't pretend that there's an inflated, somehow come out of nowhere, extra $20 basis. We have to go back to the basis of the donor, which is $100. It's sold for $150, therefore the gain is $50. And then the final question, question number 5. Jack received a gift with a fair market value of $100 and a basis to the donor of $150. He sells the gift for $50. What is his loss from the sale? All right there. I still didn't get 100% of you on. Most of you are getting it, but there's still a few of you who are confused. Let's take a look at it again. Jack received a gift with a fair market value of $100 and a basis to the donor of $150. When he sells the gift for $50, IRS is not going to allow him to realize the larger loss that would have been allowed if the donor had claimed the loss directly. Instead, he's only going to be allowed the lesser loss. 100 minus 50 is 50, which makes B, again, the correct answer. So thanks for participating in those exercises. Of course, after today's class is over, if you want to go back and revisit those, spend some time thinking through them, I'm sure if you spend enough time thinking about them, they'll start to make sense to you. So those are the rules for gifts. Now, gifts can be a little bit tricky because you have to remember those rules about fair market value on the date of the gift and cost basis to the donor, those rules. But when it comes to property you inherited, it couldn't get simpler if you ask me. And when I'm dealing with the basis of an asset and I've got a person telling me that they inherited stock, I go, woo-ha, what day did the person die? And with regards to the modern internet, I actually, this past tax season, had 2 different clients who sold inherited stock or inherited property who didn't actually know what day the decedent died. But with the internet the way it is today, all you need to know is the full name of the person and that they died, and you can just do an internet search and find usually their obituary with the date of death. So I was actually in a situation twice this year where my client had inherited property, but they didn't remember when the person who bequeathed it to them died. So over the internet, I was able to figure that out. Pretty amazing how times have changed. So let's take a look at the rules for property that you inherited. Basic calculations for inherited property are usually simple to calculate. This is because the basis in most inherited property is the fair market value of the property on the date of death of the decedent. However, the following information should be observed when determining the basis of inherited property. Firstly, we have a decedent who died before 2010 or after 2010. And in the history of the United States, that would be most people who have died would not have died in 2010. So if you required property through inheritance from a decedent who died before 2010 or after 2010, your cost basis is the fair market value of the property either on the date of death of the decedent or 6 months after the date of death of the decedent. The decedent's estate establishes which valuation date shall be used. And once the estate chooses that valuation date, that same date is used for all assets that that decedent owned. The date the property is distributed to the beneficiaries has absolutely no bearing on the issue of basis. So let's just suppose you have a client come to you and they say, well, yeah, I sold stock which I inherited. And if the question you ask is, when did you get it? You might say, well, let me see, I got the stock. I think they gave it to me in, I don't know, December of 2007. That's the wrong way to ask the question because we're not interested when they received the stock. It could be that that person who bequeathed the stock to them died 3 years earlier and that the estate was in a transition phase where it was being finalized and all of the legal issues of feuding relatives were being resolved. And finally, there comes to be a point where all of the assets of that estate are distributed to the heirs. What date that happens on doesn't matter in the least. What matters is what date did the estate select? Did it select the date of death or 6 months after the date of death? And in most cases, the date of death is selected. When you get up into larger estates, it can be the case that they will go with 6 months after the date of death. And there can be reasons why they would want to do that, but most people aren't even aware of the rule that allows them to select an alternate valuation date. And if they haven't gone out of their way to select an alternate valuation date, then it's quite simply the date of death. So let's move back on to property you inherited. We just finished talking about a decedent who died before 2010 or after 2010. Now we're going to look at a decedent who actually did die in 2010. If you inherited property from a decedent who died in 2010, special rules may apply for calculating your cost basis. There are two options for how executors could treat assets in estates of decedents who died in 2010, and these are as follows in bullets 1 and 2. But before I describe bullets 1 and 2, let me explain what was going on. It was no secret that there was a big deal happening in 2010. You should have heard about it on the news, and certainly if you were involved in the tax world, there was no end to the discussions politically and on television and professionally in tax preparation circles about what would happen in 2010. And what happened is that when President Bush came into office, he pushed through tax reforms that essentially were intended to repeal the estate tax. And the estate tax was actually, my understanding historically is that it came in under our founding fathers or shortly thereafter to prevent the accumulation of vast wealth, which contributed to the monarchies in Europe, that they were looking for a way to prevent that vast accumulation of wealth. I don't know if that's the full story behind it, but that was kind of the mind behind the estate tax when it first came into being. And so at the same time, there are many families who were losing their farms and losing their businesses because they couldn't afford to pay the estate taxes. So estate tax was seen as an important revenue source and an important social issue on one side, and it was also seen as unfair to small business on the other side. And so Bush used that platform to push through tax reforms, caused a gradual phase out of the estate tax until 2010 was the year there was supposed to be no estate tax. But the reforms that Bush pushed through had a year end of 10, and after 2010, without extension, everything was supposed to go back to where it was in the year 2000. And of course, when Obama came into office, there was a bunch of negotiation that went on between our two parties, and as a result, the estate tax is no longer repealed and is back in place. And for the year that that law passed or took effect, 2010, the estates had a choice. They could choose to follow the 2010 rule that allowed for no estate tax whatsoever, or they could choose to have the rules that existed outside of 2012, where simply you went to the fair market value on the date of death, or 6 months later, you did a valuation on the estate. If the estate was worth more than a certain amount of money, you paid the estate tax. Well, needless to say, if you had an estate large enough that you paid estate tax under the rules in place for years other than 2010, you probably went for the alternate valuation or the alternate rule that allowed you to have no estate tax at all. Now, one of the interesting things that goes on with the estate tax is although it's seen as a great evil by many wealthy people, it's a boon to everyone else because most people don't pay estate tax. When a relative of yours dies, the odds of that person having an estate large enough to have to pay estate tax is almost non-existent. There's just so few people in the world who were ever exposed to it. So for the average person, the rules for the estate tax mean that when a person dies, and let's just suppose my grandma dies. My grandma purchased a house back in 1940 for $20,000. And when she died, that house was worth $500,000. And she had a few other assets kicking around that were maybe worth another $100,000, so that when she dies, her entire estate is worth $600,000. It is miles below the level at which estate tax is due. And yet, when I inherit that house from her, my basis in that house is going to be the $500,000 it was worth on the date she died. So is that a good deal for me? Absolutely. Now, if when she died that house was worth, or all of her assets were worth $10 million, now we'd be talking about estate tax. And it's probable that the house would have to be sold in order to create liquid money necessary for paying the tax. So there is just a very small group of people that ever would have made an alternate basis election for 2010. And by that, what I mean is that if you are a beneficiary of a decedent who died in 2010, and that decedent was wealthy enough that the executor or administrator of the estate decided that they were going to follow the repeal rules, then you won't have a basis that's the equivalent of the fair market value on the date of death. You'll have some other basis. And if you're in that very small group of people, then you're going to need to read the rules. And those rules are all outlined in Publication 4895. So let's go back and read this paragraph again. If you inherited property from a decedent who died in 2010, special rules may apply for calculating your cost basis. There are two options for how executors could treat the assets in estates of decedents who died in 2010, and these are as follows. The estate executors could choose to apply the same estate tax rules for property acquired from a decedent who died before 2010, or to elect out of the estate tax rules for 2010 and use the modified carryover of basis rules under Section 1022. And for more information about all of those specialized calculations, you're going to have to go to Form 4895. Property received in exchange for services rendered, also known as barter. Generally, you must include the fair market value of property you received in exchange for services in your income. Your cost basis will then be the fair market value you included in your income in the year you acquired the property, plus or minus any adjustments. Closing costs and other acquisition costs. If you purchased a home or other real estate, you will nearly always pay closing costs. And closing costs can include things like escrow, title, and recording fees, taxes charged on the purchase of the property, loan assumption fees, points. These are called discount points or loan origination fees. Points are generally a percentage of the mortgaged amount and are considered to be prepaid interest. Other settlement charges you may have paid to acquire the property. And an illustration of how closing costs are added to basis coming up next in our manual here. Now, costs you might incur upon the purchase of property other than real property include sales tax, loan fees, title fees, and registration fees. These are common with cars but can be paid on other assets too, and then delivery and installation charges. You should note that the rules regarding the treatment of closing costs vary depending on whether the loan is for personal use or for business use property. And now we're on to adjusted basis of property. Adjusted basis is the cost basis of your property plus or minus the following. Amounts you invested in your property to improve its value, add to, or extend its useful life. Amounts you claimed as a tax credit or a tax deduction upon the acquisition of property. Postponed gains from the sale of property. Postponed gains from a like-kind exchange. Amounts you claimed or presumed to have claimed for depreciation on property that you used for business, and any other amounts you received in relation to property that have not been previously reported in your income. So here are some examples of adjustments to basis. An adjustment to basis can either reduce the basis or it can increase the basis, depending on what the adjustment item is. So in the left-hand column, we have a list of items that increase basis. So if your client spent money on these items, they've added to the basis of their property. And on the other side, we have decreases to basis. And if these types of deductions or credits have been claimed, then they will reduce the basis of an asset. So let's look first at increases to basis. Things like capital improvements, such as putting an addition onto your home, replacing an entire roof. That means tearing off your old roof and putting on a whole new roof rather than just patching up the existing roof. Paving your driveway, installing central air conditioning, rewiring your home. Also things like assessments for local improvements such as water connections, sewer hookups, sidewalks, and roads. So for example, if you live in a home that doesn't have those services and then the city comes in and installs those services and connects them to your home, they're going to typically charge you for that. And when they charge you for that, that assessment that you have to pay with your property tax bill usually, or maybe it's put as a lien on the property until it's sold, and at the time it's sold, it's paid out. Either of those two options can be what really happens. But those items are costs that you pay and they add to your basis in the property. Casualty losses. If you suffer a casualty loss and then you have to invest money to restore your property to its pre-existing condition or to even improve it beyond its pre-existing condition, that is also something that will increase your basis. Legal fees. Costs of defending and perfecting a title. Fees for getting a reduction of an assessment. Let's just suppose you have a piece of land and someone comes along and claims that part of your land is their land. And so they take you to court and you have to hire a lawyer to defend your right to your property. When you finally win, or even if you lose, what you put into trying to defend that property is going to add to your basis in the property. Zoning costs, a similar concept. If you have to pay the city money to zone the property or to change the zoning of a property, say from residential to industrial or from farming to commercial, that type of zoning cost will be a capitalization. Taxes and interest paid on unimproved real property if the election to capitalize these costs is made. Now, I'll come to it again in a minute, but when you own unimproved real estate, typically on that real estate you will have tax assessments. And the rule is that you can claim a deduction for taxes you pay on Schedule A. So if you own a piece of vacant land, and each year you have to pay $500 of tax on that vacant land, that $500 of tax you pay is deductible on Schedule A. But instead of deducting it on Schedule A, you could make a choice to capitalize it. And there can be reasons to do that. One of the big reasons to do that would be if you're subjected to the alternative minimum tax, because under alternative minimum tax, you're not allowed to claim a deduction for taxes paid. You're allowed to put it on Schedule A, but as soon as you do that, AMT will bump it back up into income. So it could be the case that if you're paying alternative minimum tax, claiming a deduction for taxes paid is pointless, and you may as well add it to the basis. But there could be other reasons to do that as well. Perhaps you're just in a situation where you don't need the additional deduction. At any rate, when you do make a decision to capitalize your costs, you have to usually make that in the year you first acquire the property. It's not something you flip back and forth on year to year. And then finally, real estate taxes or mortgage interest that are paid on behalf of the seller. Those increase your basis too, and we'll see in a minute how that works. Looking at items that decrease your basis, we begin with the Section 179 deduction. Also, a deduction for clean fuel vehicles and refueling property. Non-taxable corporate distributions. Deductions previously allowed or allowable for amortization, depreciation, or depletion. The exclusion of subsidies for energy conservation measures. The credit for qualified electric cars. Postponed gain from the sale of your home. You may have been around long enough, like I have, that you can remember the days where when you sold a house and you had a profit on that house, you had to pay tax on it. And the way out of that was to, within 2 years, purchase another home of equal or greater value than the house that you had previously owned. So there was always this concern, if I'm going to sell my house and I don't want to replace it, how much tax am I going to have to pay? And if people did purchase another house within 2 years and it was equal to or greater in value than the house they'd sold, then they didn't have to pay tax on their gain, and instead they deferred that gain, but the deferred gain reduced basis in the new home. So there's still people out there who probably deferred gain before May 7, 1997. 1997 is when that law came into effect. It would be quite easy to conceive that there's still people out there who perhaps sold a home in 1992, repurchased a new home in 1994, and are still living in it. And if that's the case, then their basis in that home they acquired back in 1994 is going to have adjustments to it, decreases in basis based on the amount of gain they excluded on the sale from 1992. The next one is a reduction to basis is going to include investment credit, part or all of what you were able to take, also casualty and theft losses and insurance reimbursements, certain canceled debt excluded from income, rebates from a manufacturer or seller, easements, and the tax credit or refund for buying a diesel-powered highway vehicle. All of those serve to reduce basis. Amounts spent to improve or extend the useful life of property. An amount a person or business spends to improve or extend the useful life of property is one of the more confusing concepts for many taxpayers. And I get this not just from tax preparers, but mostly from tax clients, of course. But interestingly, I run across plenty of tax preparers who have a hard time grasping this concept. Many people expect that they should be able to claim an instant deduction when they spend money on their property. And while the law allows for certain instances when a current year deduction can be taken, such as a residential energy credit, or if you purchased an electric car, there's certainly the electric car credits out there right now, it is more often the case that the deduction will not be allowed. In other words, you purchase an asset, well, that's very good for you. You can keep that asset and use that asset, and no, it has no bearing on your taxes. That's the way it is, especially for homeowners. You know, people have bought a home and they've spent some money fixing up the yard, and they come in to me with their shoebox full of receipts and this eager look of anticipation on their face, like they're going to be able to get some tax write-off because they put money into their house. And the answer is, sorry, unless that's a business property and those are business expenses, they're non-deductible. But if they are expenses used to improve the value of the property or extend its useful life, then they should be capitalized. So you keep those receipts in a safe place, add them up, put a total on them, and then we'll know what you put into improvements on your property. And if they were for repairs to the property, then they're not deductible now or at any time if it's personal use property. So if you use property for personal purposes, your home or your car, for instance, you generally cannot claim a deduction for the acquisition cost of the asset or for costs you incur to improve or maintain the asset. I do see another question coming from you, Keith, but I'm not sure what you're referring to. Isn't that only the case if fair market value is lower than the donor basis? Are you still referring back to our class exercises? Okay, what we'll do is I'll continue with the lecture for now, and when we take our break, which will probably be in another 10 minutes or so, we'll go back up and take a look at them again. So returning to the purchase of a house. When you purchase a house, you don't just pay $200,000 for the house because that's the asking price and that's your basis. Usually, when you purchase a house, there's going to be some fees associated with that. And typically, the fees you pay in the acquisition of a home are going to add to its basis. So let's look at an illustration. You purchased your home for $200,000. Closing costs you paid when you acquired the home included the following. The purchase price was $200,000, and you also paid title and recording fees, and you paid for title insurance and a number of other closing costs, little puny numbers that all add up to $500 by the time it was said and done. All of these costs total $203,100, and they add to your basis in the property. So although the homeowner paid $200,000, that's probably what's fixed in their mind. The offer they put down on the house is their purchase price. But when they stop and think about it, they don't ever get to go to the closing table and close on the purchase price or the acquisition price or the offer price. They usually have to go in there and bring extra money to pay these types of fees, which are usually a few $1,000s. And so whatever those fees total, they add to the basis. So in this case, your adjusted basis as of the day of sale is going to be $203,100. Then we look at some other costs that are typically paid when you close on the purchase of a home. There's usually, not always, but very often, a loan origination fee, and there's also property taxes that usually get prorated for you when you buy the house. They might appear on the closing papers. If you have to bring money to the table to pay real estate taxes for the period that you're going to own that house, or perhaps you're putting money into an escrow account, and when the money comes out of that escrow account and is used to pay those property taxes, then it becomes deductible on Schedule A. Now, loan origination fee, another word for it is points, and if you're looking in the IRS publications, they don't really talk about a loan origination fee. Sometimes they do talk about a loan discount fee, but they usually use the word points. And if you look on closing papers or the settlement statement from the purchase of real estate, you don't ever see the word point. So the IRS word point and the closing paper, the description of a point, they're usually entirely different things. So a loan origination fee or a loan discount fee, that can be a word for point. And in order to be a point, it has to be based as a percentage on the purchase price of the property. So in this transaction, we have a loan origination fee of $1,500, which is a form of point, and we have property taxes prorated of $1,500, which are also points. These amounts are entered on Schedule A, and they are deductible in the year of purchase. So even though at the time this individual went to close on the house, and they had to bring $200,000 for the purchase price, they had to pay $800 in title and recording fees, they had to pay another $1,800 in title insurance, and various other closing costs of $500. They also had to bring another $3,000 to the table to pay the loan origination fee and property taxes. When all was said and done, $206,100 is the cost of buying that home. But of that, $3,000 is immediately deducted on Schedule A, and therefore it doesn't add to the basis. And the basis then is $203,100. All right, so you can claim points and property taxes as an itemized deduction on Schedule A. Therefore, the acquisition cost basis of your home includes purchase price, title and recording fees, title insurance, and other closing costs, which in this illustration, as I've shown you, total $203,000. Now, once you've acquired that home, it's conceivable that you're going to put some money into it. Most new homeowners and even existing homeowners who've been in a place for a while are always constantly thinking about what they can do to fix the place up and make it better. And the question is, when they are investing money into their home, is it something that is going to add to their basis in the home, or is it just an ongoing maintenance thing that is an expense that's non-deductible and not added to the basis either? So if they want to be able to add it to their basis, it really needs to fall into a category called home improvement. And home improvements include amounts that you spend on room additions, adding a second story, installing a new driveway, roof, fence, deck, or patio, remodeling one room or the entire house, rewiring, replumbing, recarpeting, residing, or other similar improvements, adding or replacing fixtures such as appliances, lighting, doors, etc., city or county assessments for roads, sidewalks, sewers, etc. These home improvements add to your cost in your home and increase your adjusted basis. But examples of expenses that do not increase your basis in your home include things like repairs, such as fixing a broken lock or a hole in a leaky roof. Maintenance costs, such as mowing and maintaining your garden, cleaning your carpets, spraying for carpenter ants, cleaning your chimney, etc. The cost of refinancing your mortgage, and insurance premiums. Tax deductions and credits that can be claimed upon the acquisition of property. If you claim a deduction or a credit because you acquired property given special treatment under the law, you must subtract the amount deducted from your income or credited against your tax from your cost basis. And on the earlier page, we had a table that showed all of the different types of deductions and credits that can reduce your basis. And here we'll go through them again. Examples of the types of deductions you might be able to claim include points on a loan to purchase or improve your main home, Section 179 deduction for property you placed in service for your business, and depreciation or amortization deductions on property you used for your business. Examples of the types of credits you might be able to claim include credit for qualified electric vehicles, business credits allowed for the purchase or development of property, including purchase and or installation of certain energy-efficient devices, advanced energy projects, rehabilitation projects, and disabled access expenses paid by small businesses to comply with the Americans with Disabilities Act. So let's just randomly pull one of these out. Disabled access expenses paid by a small business to comply with the Americans with Disabilities Act. Let's suppose you own a business and you need to modify a bathroom in that business to bring it into compliance with the Americans with Disabilities Act. And it costs you $5,000 to modify the bathroom to make it accessible to individuals with disabilities. That $5,000 that you spent is most likely going to be eligible for a credit, but it happens to also be eligible for a deduction. And it doesn't really matter which way you go. Whether you claim the credit or the deduction, the basis you have in that asset will drop by $2,500 if you claim the credit, and it will drop by $5,000 if you claim the deduction. So it's your choice. And we actually take a look specifically at the Americans with Disabilities Act in our course called Federal Tax Credits for Business. And we probably mention it briefly in Depreciation Made Easy, but we take a better look at it and even do an illustration of it in our course called Federal Credits for Business. I'm going to go for another page, and then we'll take a break. So depreciation and amortization is the next topic in the manual. If you previously claimed or should have claimed depreciation on your business asset, you must subtract any depreciation allowed or allowable from your basis in the property. Allowable depreciation reduces your basis in the property you own, even if you did not claim a deduction for depreciation. And this is one I run across actually all the time. I see situations where depreciation was allowable on an asset and it wasn't claimed. Why wasn't it claimed? Well, very often it's because the preparer who prepared that return didn't know how to do depreciation, didn't realize that depreciation was required. But just as often you have a taxpayer who may have said to their tax preparer, oh, I don't want to do depreciation. I don't want to have to reduce my basis. And sometimes it's because no one knew anything about what they were doing, even on a self-prepared return, and so depreciation wasn't claimed. At any rate, it's just not a choice. The IRS says all assets need to be depreciated. And even if you chose not to depreciate the property and you claimed no depreciation deductions for your property, it is depreciated if it was used in your business. And you have to figure how much depreciation you could have claimed and subtract that from your basis. So let's take a look at an illustration. Rhonda converted her home to rental use in an earlier year. Her basis in the rental house is $200,000. Well, Rhonda properly reported income and expenses from the rental property on Schedule E. She did not claim any deductions for depreciation. Had she claimed depreciation deductions, her accumulated depreciation would be $20,000. Even though Rhonda did not claim deductions for depreciation, she must reduce her basis by the $20,000 of allowable depreciation she could have claimed but didn't. And therefore, her basis is $180,000 and not her original basis of $200,000. Note that although Rhonda must reduce the basis in the property by the amount of allowable depreciation that she could have claimed, IRS procedures do allow her to apply to the IRS for a change in accounting method by filing Form 3115, change in accounting method, and specifically completing Section E of that form. In the year that Rhonda applies for the change in accounting method, she will be able to claim on Schedule E of her Form 1040 a deduction for all the prior year's depreciation she could have claimed and didn't. So for more information on that, read the instructions for Form 3115. So if you haven't heard of that provision, and it's not a new one, I remember sitting at an IRS forum back in 1997 and hearing a person with the IRS there talking about this procedure. So it's definitely not new, and I'm sure it was around a long time before I got into taxes. But it's a very straightforward one. On this Thursday, I'm going to be teaching a class called Depreciation Made Easy, and in that class, we really burrow into how you correctly calculate depreciation. There's all kinds of rules that have to be applied in the calculation of depreciation. And it's not surprising that lots of times people get those rules wrong. They might depreciate an asset too much or too little. And when are they going to find out about it? They might find out about it when they change tax preparers. They go from one who didn't know what they were doing to one who does know what they're doing. It might happen when a banker is looking at things and a banker's got a pretty good grasp on depreciation. They might notice, hey, that's kind of wacko. Where did those numbers come from? Or it could be that they're audited and the IRS auditor is going, these numbers don't add up. Hey, dude, it's wrong. Or it could be that just when the asset is sold, the preparer is handling that transaction on the sale is figuring out that they're just not looking right. At some point, someone figures out the depreciation doesn't quite look right. Well, at the time it's discovered that the error is made, that's when you can make a decision. Well, what can I do? Now, if you only are dealing with 1 year of incorrect depreciation, the logical thing is to go back and amend. But if you're dealing with multiple years, going back in time, sometimes well beyond the statute of limitations, that's a lot of work, and IRS basically has a procedure in place that says, hey, prepare a schedule, and on that schedule show the amount of depreciation you have claimed. And then also show the amount of depreciation you should have claimed. And if you claimed less than you were supposed to, then that difference is allowable to you as a deduction. You need to attach Form 3115, you need to attach the schedule showing how you figured that difference, and then claim the deduction. And if you figure you've claimed too much depreciation, because that's possible too, then you're going to have income that you need to report. And don't take my word for it, but I believe the income, if you discover the error and you voluntarily come forward and report, hey, I've claimed too much, so that I now have income. You can elect to report all of the income at one time in the year you discover the error, but I believe there's also a provision that allows you to carry that out over time, and I think it's about 3 years. So at any rate, it's a nice way out, nice way to resolve a big issue. And certainly, if you don't even realize there was an error in depreciation until that property is actually being disposed of and you're preparing the tax return, reporting the sale, and you observe that no depreciation was claimed but should have been, then what you need to do is reduce the basis by the depreciation that should have been claimed, and then you claim the deduction for depreciation all at one time with 3115 attached in the year of sale. See a question here, what about prorated interest, which is deductible on Schedule A? Well, prorated interest is going to never add to basis, unless, of course, you're looking at a decision to capitalize interest payments that you made on investment property. But if it's on a house or a business asset, then interest is never capitalized. It's always deductible. Presumably deductible. It depends on the kind of interest it is. If it's personal interest, it may be deductible as long as it's home mortgage interest. MOA. M-O-A. MOA. Let's look at what I've put on the screen in front of you. It's the present. It's a question from the C exam or AC exam from sometime in history, and updated to be in compliance with today's rules, which frankly haven't changed over the past decade or longer. And here's the question. Bill, a tax preparer, agreed to prepare a corporate tax return for the Easy Interior Decorating Company. It was agreed that Bill's fee would be $4,500 for his services. EZ was experiencing cash flow problems and offered Bill a computer with a fair market value of $3,500, a printer valued at $400, and a monitor worth $250 instead of the agreed upon $4,500 cash. EZ had paid $6,000 for these items, and Bill accepted the equipment in lieu of cash. What is his basis in the property? A slide, note screen, to show how or why B is the correct answer. So when we're dealing with barter, your basis in an asset is the value of that asset when you received it in exchange for whatever item you've given up in the barter. And in this case, we've got a barter of services for an asset or a series of assets. And so what the basis of the company is in those assets is not really relevant. Their adjusted basis is not the value that is going to be included in income of Bill. And ultimately what's going to happen is Bill is going to take the fair market value of the computer at $3,500. He's going to add $400 for the printer and a monitor valued at $250. And he's going to add all of those up. And when he does that, he gets $4,150. That $4,150 is taxable income to him. He's going to report it on his tax return as income, and because that's what he reports on his tax return as income, it becomes his basis. And for more on that, refer to page 6 of publication 551 for property received for services. Let's look at the next poll in line. And this one involves a character named Tony. He purchased a truck to be purchased in his excavation business. The truck's cost was $22,000, and in addition, Tony paid sales tax of $1,100 and $900 of freight to have the truck delivered immediately from the dealer. What is the depreciable basis of the truck? When we're looking at basis, your acquisition cost of property includes taxes you pay on the acquisition of the property, includes the acquisition price of the property, and includes any delivery charges of getting that property delivered. Also, if the property needs to be installed, any costs of installing it. And in this case, we have a purchase price of $22,000, we have sales tax of $1,100, and we have freight of $900. When we add those numbers up, we do get $24,000, and that is the correct answer. The next poll question is the last one I'm going to ask you for a while. It's another C exam question. And C, if you're not familiar with what the C is, that's the IRS's special enrollment exam. If you are able to pass the C, then you can become an enrolled agent. And this question from the C exam says, in 2010, you bought 100 shares of XYZ stock for $1,000 or $10 a share. In 2011, you bought 100 more shares of XYZ stock for $1,600 or $16 a share. Then in 2012, XYZ declared a 2-for-1 split. Which of the following is correct? You now have 200 shares with a basis of 5. You now have 200 shares with a basis of 8. You have 400 shares with a basis of 650. Or D, both A and B are correct. Let's think about what's going on here. We're dealing with a 2-for-1 split. And what happens with a 2-for-1 split is a company whose stock has been trading on the stock market decides to split that stock to lower the price of the stock on the market. So if the stock has been trading for $10 a share and then a decision is made to split the stock, now the number of shares you have has doubled, but therefore the cost of each share is cut in half. And in this case, we have two separate purchases of stock. One purchase was 100 shares, the other purchase was 100 shares. And what happens when a stock split occurs? Well, the 100 shares from the first purchase become 200 shares, and the 100 shares from the second purchase become 200 shares. And then we have the first 100 share purchase, the cost has gone from $10 a share down to $5 a share. And with the second purchase of 100 shares, you now have 200 shares, and therefore your cost has gone from $16 a share to half that amount, $8 per share. So in reality, both A and B are correct, which is why D is the correct answer. And for number C, you have 400 shares with a basis of 650. That would be the incorrect way of handling it. So let's move on again with our manual. And now we're going to be looking at postponed gains from a like-kind exchange. I talked quite a bit about postponing the gain from the sale of your home. And now we're going to look at another kind of postponed gain. And this is the kind of postponement that happens in a like-kind exchange. If you previously elected to postpone the gain on the disposition of your property because you traded the property in a like-kind exchange for property that is like-kind, you must subtract any postponed gain from the basis of the new property. And we actually, in depreciation, I do talk about different types of property and how they are classified so that you can determine whether a property is like-kind. I touch on it again in the course that we'll have called Sale of Assets. We teach a class on like-kind exchanges, and we really go into how you complete the form to perfect the like-kind exchange. But for today, all you need to know is that if you do have a like-kind exchange, the rules for it are similar to the rules for postponing a gain from the sale of your home, if you had a home that fell under the rules in play before May 7, 1997. Except for postponement of gain on like-kind exchanges, that rule is still around. It hasn't expired, and so people are still, every day here in the United States, engaging in a like-kind exchange. And the most common like-kind exchange we may hear people talk about would be a real estate for real estate like-kind exchange. I have a rental property. I want to trade that rental property for another rental property. And I don't want to have to pay tax on the sale of my existing rental property. I want to be able to roll that somehow into a new property. And the concept behind a like-kind exchange is there's supposed to be a trade. And in our earlier poll question, we had the tax preparer trading his services for a computer. Well, that's not a like-kind exchange. Tax services and a computer are not remotely the same. So that is not a like-kind exchange. But let's just suppose you trade your computer for another person's computer. That would be a like-kind exchange. And the rules for like-kind exchange are mandatory. You can't opt out of them. If you have a like-kind exchange, then you have to treat it as a like-kind exchange. And a like-kind exchange means that the gain, if there is a gain, is not recognized or realized for tax purposes unless there's boot involved in the transaction. And boot is a form of cash or other property that is not like-kind. But like-kind exchanges actually go on around us all the time, and they don't always necessarily involve real estate. Probably the most common kind of like-kind exchange we would see going on, and one which we've probably all been directly involved in at some point or another, is trade-in of an old car for a new car. You go to the dealership, you see the new car you want, you do a trade of your old car for the new car, and you kick in cash for the difference. That is a like-kind exchange. Now, if it wasn't a business use car, it's a personal use car, you're not going to be filling out a like-kind exchange form, and the rules for like-kind exchanges won't really apply. Well, they could apply, but they're not reportable. You don't file the Form 8824 to report them. But if it's a business use asset and you have a like-kind exchange, you have to file Form 8824 to show the IRS how much unrealized gain you had. And whatever amount of realized gain that you have is gain that you don't pay tax on. It serves to reduce your basis so that later on when you finally sell the property that you received in the trade, the basis in that property has been reduced, and if you finally sell it for a gain, that gain is going to include all of the appreciation it had during the time you held it, as well as the appreciation or profit from the prior sale that was never taxed at the time of the sale. So important rules relating to basis of real estate is our next topic. There are a number of common events that affect basis of real estate. IRS rules for these events are discussed here. If you paid real estate taxes owed by the seller of a property as part of the purchase cost of the property, add the taxes you paid to the seller or for the seller to your basis in the property. You cannot deduct them as taxes paid on Schedule A, C, or E. Well, we discussed why this is the case when we were covering itemized deductions for Schedule A. Last week we had a course on itemized deductions, and there we talked about deductible taxes. And the rule is that you are only allowed to claim a deduction for a tax that is assessed on property you own or on income that you've earned and that is paid by you. So if you pay taxes on property that you're buying, the taxes have been assessed for a period of time when you didn't own the property, then you're paying the taxes for someone else. And you can't claim a deduction for taxes you pay for someone else. It's just a flat-out rule. So what the IRS says is that if you do that while you're buying a property, then you do not get to deduct those taxes, but you do add them to the basis you have in the property. So let's think of an example of how that would work. Let's suppose you purchase some vacant land for a price of $100,000. And the person who's owned that land is in arrearages on their property tax. They owe $10,000 of property tax. They've never paid it. So when that property sells and you pay $100,000 for that property, you're going to have to bring more money to the table to pay the property taxes for that buyer. And so instead of closing at $100,000, you close at $110,000. Then those taxes that you pay for the seller mean that your acquisition cost in that property is $110,000. Even though the agreed upon purchase price was $100,000, the fact that you paid taxes for that seller means that your basis has now bumped up to $110,000. Now what happens if it goes the other way? Here in this first illustration we had real estate taxes paid for the seller by the buyer. What happens if we have real estate taxes paid by seller for buyer? The other way around. If you are the seller and you pay taxes for the buyer, you will add that to your basis as well. And the buyer can then deduct those as appropriate on Schedule A, C, or E, but you do not get to deduct them on Schedule A, C, or E. So again, anytime if you pay taxes that are not assessed upon property you own for a period of time where you are the owner of the property, in other words, you pay them for someone else, but the way you pay them is a part of the sale or the acquisition of that property, then the taxes that you don't pay that are for the other person are automatically going to add to the basis. Settlement costs, which also add to the basis of property. A fee paid to buy property is a cost that must be paid even if you bought the property for cash. So if you are purchasing property and you pay settlement costs, those will add to your basis, and any fee you pay for property is a cost that must be paid even if you bought the property for cash. So we're comparing that with a loan. If you take out a loan, you might have to be paying fees or amounts of money to get the loan. You have to go through all of those closing procedures. You have to get appraisals on the property. You might pay points to acquire the property, lending documents, all kinds of charges going on. And those are associated only because you're getting a loan. But even if you weren't getting a loan and you were just buying the property for cash, there's certain fees you'd have to pay anyway. And those are called settlement costs, and they do add to your basis. So the following items are examples of items that are going to add to the basis of your property because they are settlement costs. Charges for installing utility services, legal fees including title search and preparation of the sales contract and the deed, recording fees, surveys, transfer taxes, owner's title insurance, and any amounts that the seller owes and you agree to pay for the seller, such as back taxes or interest, recording or mortgage fees owed by the seller, charges for improvements or repairs, and sales commissions. Loan and other costs are not added to the basis of property, so do not add the following costs to the basis of property you buy. Costs and fees paid for getting a loan on the property or amounts placed in escrow for future payment of items such as taxes and insurance. So loan fees that don't have to do with the acquisition of the property directly still are costs most people have to pay if they want to acquire property. Whether it's for business or personal purposes, expensive property, most people probably take out loans to buy it. And so is it fair to say that those costs associated with borrowing money aren't deductible? And the answer is, it isn't that we're talking about a deduction, it's whether or not they add directly to the basis in the property. And they do have a cost, and the IRS does allow you to record that cost, just not by adding it to the basis of the property. They want you to figure that cost and carry it separately. So let's look at loan fees. These include points, discount points, and loan origination fees, mortgage insurance premiums, loan assumption fees, the cost of a credit report, fees for an appraisal required by a lender, and fees for refinancing a mortgage. Escrow items are different again. We can have settlement costs, we can have lending costs, and we can have escrow items. They're all different categories, and they can all appear in the settlement papers when we're purchasing a house. So the following items or examples of settlement fees and closing costs that you cannot include in the basis of property either. And they include fire insurance premiums, rent paid to occupy a property before closing, and charges for utilities or services related to occupying a property. So most people, this is kind of a general assumption, I haven't ever done a statistical survey, but most of my customers, when they purchase a home, they take out a mortgage. And at the time you purchase the house, very often it's mandatory that you have an escrow account with that mortgage company, and into that escrow account, you're going to be putting monthly amounts that are going to be building up within that escrow account, and then at some point, the mortgage company is going to take the money from escrow to pay your property taxes and your insurances on that house. And typically, mortgage companies require that until you have at least 20% equity. And at the point you have 20% equity in the property, then the escrow accounts become optional. But even when they're only optional and not required, lots of people choose to do it. It's much easier to put $200 a month into the escrow account than it is to come up with $2,400 when the taxes are due. And so people do take advantage of that. But any amount going into an escrow account doesn't add to your basis, nor is it an expense. It's like putting money into your savings account. It's there, it can be used for a particular purpose, but it hasn't been spent yet. And until it is spent, it's not an expense. So money in the escrow account, money you deposited into an escrow account is not deductible, but when that money comes out of the escrow account and is actually spent, then it may become deductible. It just depends on what the money was spent on. The next item we're looking at is loan and escrow costs paid to acquire business use property. If you paid loan or escrow costs relating to business property you own, you should capitalize or deduct these costs as follows. For loan fees, these are capitalized and amortized separately from the property purchased. And here's an example. The purchase price and closing costs of a residential property, rental property, are depreciated over 27.5 years. The loan fees paid to purchase the rental property are amortized separately over the life of the loan. And here we have an illustration. A rental house is purchased at a cost of $120,000. $100,000 is allocated to the building and $20,000 to the land. Loan fees paid on acquisition of the property totaled $3,000. The cost of the rental house and the loan fees should be entered on a separate line of the schedule for depreciation. And so we have a depreciation schedule here, and when everything's being done like it should be, you should see a line for the building, and it should show the original cost of the building, and then it should show the depreciable basis. Now, every software program does the depreciation schedule a little bit differently, but somewhere on that depreciation schedule, you want to know that the land value has been subtracted out. And this is a mistake I see tax preparer after tax preparer do, which is they'll say, okay, how much did you pay for the rental property? $200,000. They'll enter that down on the depreciation schedule as the cost. It is the cost, but it's not the depreciable cost. And we'll see on Thursday's class in Depreciation Made Easy that land is never depreciable. The IRS, our federal government, is of the opinion that land does not get used up or worn out, that it's there forever. Now, if you happen to live on a beach with erosion, like Hurricane Sandy eroded lots of beaches and lots of people live in a country where there is beach erosion, I'm not quite sure how all of that comes into play. But overall, in general, the feeling is that land is there forever and therefore you can't claim a depreciation deduction for it. And so, since all buildings are built on land, you need to figure the land value and subtract that out. Now, there are some exceptions. For example, if you purchase an apartment in an apartment complex, very often it's the case that there's deemed to be no land value, that the only asset you have is the apartment and that there's no land value associated with that. But for your typical homeowner, there's definitely land. For the typical piece of real estate used for business, there's going to be a land value. And that has to be subtracted out so that you don't depreciate the land. So you start with the cost of $120,000, you take out the land costing $20,000, and you're left with a basis for depreciation of $100,000. And then we look at the useful life of that asset. In this case, it's a residential rental. You're going to depreciate that residential rental over 27.5 years, and that will give you a $3,636 deduction per year. Every year except the first and the last year, of course, but we'll say that this is any year other than the first or the last. We then have the loan fees, and the loan fees have a cost of $3,000. They have a depreciable basis of $3,000, but actually we don't get to depreciate those. Loan fees are amortized, which is a different method of figuring a deduction, and they are amortized straight line over 30 years, and that gives us $100 a year for a deduction. So the depreciation schedule, when completed correctly, should be carrying these line items separately and not merging them together. Now, technically, if you do merge them together and you were to add $3,000 to the building, and depreciate everything over 27.5 years, you can see that you'd be claiming slightly too much amortization each year. Is it going to be the end of the world? Is the sky going to fall because it was not put on a separate line and because it was depreciated over 2.5 years too few? Unlikely that it will cause the sky to fall, but certainly an auditor could pick up on it and want to make an adjustment for it if it's a significant difference. How did I determine that the land was worth $20,000? Because in the wording of the problem, I told you it was, Paul. A rental house is purchased at a cost of $120,000, $100,000 is allocated to the building, and $20,000 to the land. I just made those numbers up and put them in my problem. But in the real world, is that what you're asking? How would you determine what the land value is? Well, I go to property tax assessments. Every county in the country assesses real estate taxes on property, and they're going to have an assessment. Now, you could have an appraiser come out and assess what the land is worth and what the structure on the land is worth. We don't ever go there, at least I don't ever go there. Instead, I just rely on the county assessments. And those are easily obtainable. They're public knowledge. You just need to go on the internet, type the name of the county that the real estate is in, and then do a search on their website. And they will certainly come up with the assessed value of that property. And then typically, they'll also break it down between the structure value and the land value. Now, very often, they're not market value. They might say they're market value, but you might know otherwise. So the county might say, well, this $200,000 piece of real estate, we're allocating $50,000 to the land and $150,000 to the house. And you're going, but wait, this property is worth $400,000. Where are they getting $200,000? Well, it doesn't really matter. As far as I'm concerned, they're saying that 25% of the value of the property is land. Even if the purchase price doesn't match $200,000, I'm going to say if the county says that 25% is land, I'm going to take 25% of the acquisition price and apply that as land. Now, that's a reasonable method of doing it, and it would be an acceptable method to the IRS because it is reasonable, but other reasonable methods could apply if you could show that the county assessment is not a real assessment because perhaps a skilled real estate agent or a skilled property appraiser has given you other numbers. You can go with those as well. And then I see another question. Robin is asking, how might this work if the loan is a 15-year loan? Is depreciation amortization based on the length of the loan? And that is true, yes. So you will look at the length of the loan. Most people take out 30-year loans, but I've seen 10-year loans, I've seen 15-year loans, I've seen 20-year loans. So the amortization life is going to be the life of the loan. Escrow items. Escrow items are deducted as an operating expense at the time payment is made, not when you put the money in. I explained that earlier, but now I have an example. Tammy's monthly mortgage payment amount is $2,000, and every month $200 of the total payment is deposited into an escrow account, which is used to pay her annual property tax bill. Another $50 from each payment is deposited for use in paying insurance premiums for the house. The amounts deposited into her escrow account are not deductible to her until the money is distributed from escrow for these purposes. In addition, the amounts in her escrow account do not add to her cost basis. Insurance premiums and property taxes paid from an escrow account for the costs of keeping up a rental home are deducted on Schedule E at the point they are actually paid. So let's just suppose, and I've seen this happen, you've got a client who's been properly paying into their escrow account with every mortgage payment they make. And at the end of the year, their escrow account is sitting at $3,000. And the reason it's sitting at $3,000 is that earlier in the year, a property tax payment should have been made from escrow, and it wasn't. I really literally had a client one year where I was looking at their 1098 mortgage statement, and it was not showing that taxes had been paid. Now, there's no requirement that the 1098 show that they've been paid, but it was normal for that particular mortgage company to show that they'd been paid, and hers was not showing that they'd been paid. So I thought, well, that's rather odd, and she didn't know otherwise either, but we just couldn't find any evidence that the escrow account had actually been paid out. So I finally called the county and talked to the people at the county, and they confirmed that no property tax payment had ever been made. And so all of the money literally was still sitting there in escrow with the mortgage company, and quite clearly we had a pretty upset tax client because they weren't able to claim a deduction for it. And not only that, they were now in arrearages on their property tax. So the mortgage company had really dropped the ball there. What eventually happened in terms of late payment penalties and so forth, I imagine the mortgage company had to cough that up. But ultimately for my client, it meant in the year I was preparing the return, they couldn't claim a deduction because the tax had never been paid. we had a year where they weren't paid when they should have been, and they were paid late in the next year. So in that next year, we had taxes that were paid for that year, plus we had taxes later in the year for the same year, so we ended up in the second year having deductions for 2 years of tax. Treatment of loan and escrow costs on personal use property. Loan fees and escrow costs relating to the purchase of your home do not add to your basis in the home. If you paid points on the purchase of your home or made escrow deposits to pay your taxes, these amounts are deducted on Schedule A. And I've already given you a couple of examples, but I'd like to keep giving more just to drill it home. Points on a refinance of the home are claimed in the year of sale. And so we have Joanne. She paid $3,000 in points when she refinanced her home in an earlier year. And she'd been amortizing the points on Schedule A and claiming $100 of deduction each year. By the time she sold the home, she had recovered $1,200 of her cost in the points paid as of the time she sold her home in 2012. So when you have points that you pay on the sale of your home or purchase of your home, those are deductible in the year of purchase. But later on, if you refinance the home and you pay points again on the refinance, the IRS says those points are still deductible, but not all at once. They have to be amortized over the life of the loan. And if at the time that you either sell the home or refinance a second time, those points have not been claimed in full, then in the year of that second refinance or that sale, you can claim any balance of points. So let's go back and revisit this Joanne again. Joanne paid $3,000 in points when she refinanced her home in an earlier year, and she'd been amortizing points on Schedule A and claiming a $100 deduction each year. She has recovered $1,200 of her cost in the points paid as of the time she sold the home in 2012. And so the balance of points, which is $1,800, would be deductible on Schedule A in the year she sells. Election to capitalize mortgage interest and property taxes on unimproved property, real property. I touched on this earlier today. Here's more on it. If you own unimproved real property, that is vacant land, you can either deduct mortgage interest and property taxes you pay on the land as an investment expense, or you can elect to capitalize these costs. The following costs of owning unimproved land and unproductive real estate can be capitalized. They include annual taxes, mortgage interest, and other carrying charges such as legal fees or association fees paid in association with the land. The election to capitalize is required. It's not just something that you decide after the fact. You have to make a decision to do so. You must file a statement with your original return for the year you wish to make an election to capitalize these costs. The statement must indicate the item or items that you wish to capitalize. Amounts received in relation to your property. If you have received financial or tax benefits in relation to your property that were not included in your income in a prior year, you must subtract these from your basis. And examples of these benefits include rebates received from a manufacturer upon acquisition of property. So let's just suppose you purchase a computer and it costs $1,000, but it comes with a $100 mail-in rebate. Or you mail in the coupon to get your $100, and you receive the $100 as a check a few weeks later. The fact that you've received a rebate back of $100 means that your cost in the property is not $1,000. It is reduced by $100 and is now $900. Examples of other benefits include forgiven or canceled debt on a loan that was secured by the asset. So let's just say, and we've had a lot of this going on, you own a home. And at the time you bought that home, it was in the bubble, 2006. So you paid $500,000 for the house, and you took out a $300,000 mortgage to buy it, plus you took out a second mortgage of another $100,000. So you had only 10% equity in that house. You had a main mortgage of $300,000. You had a second mortgage of $100,000. And in 2009, the mortgage company holding the second decides to just discharge it. It may be that you negotiate that discharge. It may be that they voluntarily come forth and do it, but they discharge $100,000 of debt. Well, that discharge of debt is not going to be taxable to you if this is your main home and you meet all of the other tests for being able to exclude it from your income. But if you exclude the $100,000 from your income, you must also reduce your basis in that home by $100,000. So the purchase price, $500, minus the canceled debt of $100 would reduce your basis to $400,000. Insurance reimbursements you receive from a casualty or theft loss can reduce your basis, as well as tax deductions you claim for the casualty or theft loss. The next item we're looking at is the Uniform Capitalization Rules. The Uniform Capitalization Rules require you to add certain costs to basis in certain circumstances. The term capitalize means to include certain expenses in the basis of property you produce or in your inventory costs rather than deducting them as a current expense. Capitalized costs are recovered through deductions for depreciation, amortization, or cost of goods sold when you sell, use, or otherwise dispose of the property. What kind of activities are subject to the rules? Well, you must use the Uniform Capitalization Rules if you do any of the following in a trade or business or other activity that is carried on for a profit, including you produce real or tangible personal property for use in the business or activity, or you produce real or tangible personal property for sale to customers, or you acquire property for resale. The IRS says you produce property if you construct, build, install, manufacture, develop, improve, create, raise, or grow the property. And tangible personal property includes things like films, sound recordings, videotapes, and books or similar property. Now, under the Uniform Capitalization Rules, you must capitalize all direct costs and an allocable part of most indirect costs that you incur due to your production or resale activities. Any cost you cannot use to figure your taxable income for the year is not subject to the capitalization rules. And here are some exceptions. These are essentially people who don't have to follow the Uniform Capitalization Rules. Property you produce that you do not use in your trade or business or activity conducted for a profit. So you just have a hobby and you make a few things and you don't have to use the Uniform Capitalization Rules there. Qualified creative expenses you pay or incur as a freelance, self-employed writer, photographer, or artist that are otherwise deductible on your tax return. So what this is saying is if you do tax return for a writer or an artist that produces their own painting, they may produce the painting over a period of time and they may have all kinds of expenses that go into the production of that painting, and they're going to be allowed to deduct those as they go year to year. When they finally sell the painting, that would be self-employment income to them. And so they don't have to apply the Uniform Capitalization Rules because they're self-employed. But if they were doing the same type of activity as an employee of a business, then all of the amounts that business pays that artist to produce their work have to be capitalized under the Uniform Capitalization Rules. Property you produce under a long-term contract except for certain home construction contracts. Research and experimental expenses allowable as a deduction under Section 174. Costs for personal property acquired for resale if your average gross receipts for the 3 previous years do not exceed $10 million. So the Uniform Capitalization Rules are applied to inventory usually. And if you are in the business of buying and selling property, you're supposed to use the Uniform Capitalization Rules. However, if your gross receipts, average gross receipts for the past 3 years do not exceed $10 million, then you don't have to apply them. Also, do not capitalize certain costs that are not deductible as ordinary operating expense. An example of a non-deductible expense is the 50% of meal and entertainment limitation. So you might be wondering, well, gee, I did a bunch of research on this project and I had to travel all over, meet all these people. I had all of these costs, including meals and entertainment. Don't the meals and entertainment add to my basis? Well, they do, but only half of the meals and entertainment add to your basis. The other half does not add to basis. Now, there are additional rules that apply to farmers. The Uniform Capitalization Rules do apply to farmers, and there are differences in how farmers are allowed to claim depreciation based on whether they choose to follow the Uniform Capitalization Rules or not. And for more information on farmers and how they're affected by the Uniform Capitalization Rules, you should refer to Chapter 6 of Publication 225. All right, so why track the basis of property? Well, clearly, if you use property for a business purpose, there's every reason in the world to track the basis, and that is, well, you're required to. But if it's personal property, is there a reason to have to worry about the basis? Say on your house. I'm not allowed to deduct any expenses I incur in maintaining my home, so why should I keep track of that? Or if I take a room addition, put that on my home, I can't deduct it, why should I bother with that? Well, we never know what the future is going to hold. We never know if a day is going to come where we're going to convert that property to rental use. And if the day comes where we convert our home to rental use, we're going to want to be able to show that we have an adjusted basis that includes all improvements we may have made to that home over a period of 10, 20, even 30 years. How are we going to prove that? Because we kept records. And if you can't prove a basis because you didn't keep records, then the IRS says whatever records you can't show, they're not going to accept that you have that basis. So you should keep accurate records of acquisition costs, of improving your property for when you sell it. That's the logical thing. But it could also be the case that you may convert it to business use. So Right now we have a rule in play that says if you sell a home at a capital gain and you've owned that home for at least 2 years and occupied it as your main home, then if you sell it and your gain is $250,000 or less, then the gain is not taxed. And for a married couple, it's twice that. But let's just suppose what you sold was not your main home, it was a second home. Well, you're not going to be able to exclude the gain on a home that was your second home because it doesn't meet the rules. Or it could be maybe you meet the rules for excluding it on your main home, except you paid $100,000 for the home and now it's worth $500,000 and you're single. You're still going to have a taxable gain. You're going to be able to reduce it by $250,000, but your gain is more than that, so it's still going to be taxed. So again, that's another reason to keep hold of all records you have regarding improvements you made to the property. So our next topic of the day is basis of stock. And when it comes to businesses, we're depreciating property, we're often disposing of assets. That's fairly complex stuff. So I did want to cover in this first part of our course all of the rules for figuring the basis of assets, whether they're for personal use or whether they're for business use. But when it comes to reporting gains and losses for our customers, at least in my experience, usually I'm dealing with Schedule D and Form 8949 because they sold stock. And the sale of stock can be complicated. There's all different kinds of reasons why it can be complicated, and we're going to be looking at how all of the rules for stock work. You calculate your basis in stock the same way you calculate your basis in other property. However, sale or disposition of stock is often subject to special treatment, so it's important to be aware of some of the rules affecting the sale of stock. The most confusing aspect for many people is determining the acquisition date and price of the stock. How you acquired the stock is the first step in solving this problem. Possible methods of acquiring stock include purchase, gift, inheritance, divorce, employee incentive stock option plans called ISOs, employee stock purchase plans called ESPPs, and employee stock awards called RSAs, and restricted stock units called RSUs. Now here in the Pacific Northwest, the city of Portland is a hub of high-tech activity. Seattle is as well, and of course the Silicon Valley of California are full of high-tech industries. And I don't know about other industries because we don't have much else out there. Maybe we have Nike here in Oregon. They're not high-tech, but they're definitely active in these types of employee plans as well. And what happens when you have a large company, and sometimes even smaller companies, is they use stock to pay their employees. Instead of giving the employee a paycheck, they give the employee stock. And if you go read the rules for taxable fringe benefits, that's IRS Publication 15B, it basically says anything you use to pay your employee is compensation to that employee and money that they have to pay tax on. But there are some specific exceptions where an employee may be able to receive stock or receive stock for more than they paid for it and not have that treated as a wage. And that's when we get into these concepts of ISOs, ESPPs, RSAs, and RSUs. And since I see so much of them around here in Oregon, I've gotten to be pretty good at it. Every day in the doors of our office, we have clients who have these types of options. And so I'm going to show you what I've learned and hopefully teach you something of value for your clients. Purchase of stock. If you purchase stock, you should keep accurate records of purchase dates and the number of shares of each kind of stock that you bought. Most investment companies keep computerized records of your transactions. So if you have a stock portfolio with a brokerage firm, they're probably going to keep computerized records of your transactions. But historically, when you switch from one brokerage firm to another brokerage firm, that transaction history doesn't follow you. Now, there are new rules that are in play that are requiring those companies to share that information and allow it to transfer when you switch brokerage houses, but they're not fully in play yet, and they're not required for much stock that's still being held. So it may be that you have a person that has transferred from one brokerage company to another and the basis information has transferred, or it may be that it didn't transfer. Whether or not the brokerage company kept track of the records, you're still required to. And you should keep all records for your stock purchases from the date you purchased the stock until 3 years after you sell the stock. So if you purchase stock and you hold it for 20 years and then you sell it, that means you have to keep the records for 23 years, the 20 years that you owned them, plus 3 years after you sold them. Most people aren't so good at doing that. Be especially sure to keep records of any stock splits or spin-offs that might occur while you hold the stock. And that was where we gave you the C exam question today and why that's important. Basis reporting on Form 1099-B. A Government Accountability Office study showed that 7 million taxpayers, more than one-third of those who sold securities, may have misreported capital gains and losses, and about half of them did so because they misreported their basis. A new law aimed at reducing basis reporting errors by taxpayers began phasing in for tax year 2011. The law requires basis reporting on Form 1099-B, which is the document called Proceeds from Broker and Barter Exchange Transactions. And the new reporting requirement applies to all stock purchased after 2010, with the exception of certain mutual funds and certain commodities. And commodities are phasing in for 2013, and mutual funds phased in for 2012. And so beginning in 2011, the IRS redesigned 1099-B. 2012, it redesigned it again. We're looking at the 2012 version of the 1099-B. And what I'm pointing at here, box number 3, if you have stock that was purchased after 2010, the brokerage house is required to put your cost basis in the stock in box 3. And then you'll see box 6. You can see that you either check box A because it's non-covered, or you check box B because it is covered. Non-covered stock is stock that was acquired before 2011. And if it was acquired before 2011, then the basis will not be entered in box 3. If it was acquired after 2010, then the basis should be reported in box 3. And the exception to that is if it was mutual fund shares, then the basis reporting for mutual funds and for other types of stock occurred in 2012, but the commodities are the last holdout, and they'll start in 2013. Gifted stock. If you receive stock as a gift, you should ask the person who gave you the stock for their records of the original purchase. Your basis when you sell the stock will be calculated in the same fashion as for other gifted assets. For example, your basis for calculating stock loss or gain on the sale of gifted stock will depend on whether the fair market value of the stock is less than, equal to, or greater than the donor's adjusted basis at the time of the gift. If the person or entity that gives you the stock does not have accurate records, try to get an accurate purchase date. You consult periodicals and other reference sources to determine the fair market value of a particular type of stock if you have the following information: the purchase date, the number of shares purchased, the name of the company or mutual fund, the number of stock splits that have occurred since the stock was issued, and the number and valuations of any shares allocated to a new spin-off company. Now, I've got a link in here to bigcharts.com. That's an internet site that I go to quite frequently because I can get historical stock quotes on it. If you're looking for a historical price on a stock that is more than 10 years ago, you have to pay for a subscription to Big Charts. I don't do that. Once I get to a point where it's more than 10 years old, I start harassing the brokerage firm. Or even calling the company directly. For example, I don't need to consult bigcharts.com to figure out what the basis is in AT&T stock because AT&T's website will tell me that. But let me give you a couple of examples of things I've done to figure out the basis of stock over time. Now, this is more often done with inherited stock because we're just looking at the date of death. But a couple of times over time, I've got a situation where a gift of stock was given. The person who gave the gift has died. The person who received the gift has no idea what the cost basis was. And so we're left with, what do? We can either assume there's no basis, which the IRS might decide, or we can assume that there was a basis, and that basis is probably what the stock was worth on the day it was originally acquired. So is there any way for us to figure out when that stock was acquired and then contact the company and find out what that stock traded for back then? And one of my oldest examples is a man who came to visit me many, many years ago. And when he was born, right about the time of his birth, his grandfather bought him shares in Pittsburgh Steel Company. Their shares were bought in commemoration of his birth, and they were put in his name at that time. So although we didn't know the exact day, we knew that those shares were probably purchased pretty close to that day. And so at that point, this is so long ago, we didn't have the internet and big charts. I ultimately called Pittsburgh Steel Company and talked to a vice president over there. And she did the research and came back to me and actually told me what Pittsburgh Steel had traded for on the date of my client's birth. And so that was the date we used as the basis. Now, he was never audited on it. I can't speak to what the IRS would have allowed or not allowed, but they do go on testimony. They go on reality. It's obvious that you don't get shares in Pittsburgh Steel Company without having a basis of some kind. And that was a very reasonable method, I felt, and one that should be able to be supported. Now, inherited stock, the law is totally spelled out. You're going to go usually with the fair market value on the date of death. And actually, it isn't just the fair market value on the date of death, because the fair market value on the date of death is going to vary. It's going to move with the market up and down during the day. And so actually what you do on inherited stock is you're going to look at the high value of the day and the low value of the day, and you're going to average those. So if the high value of the day was $10 and the low value of the day was $9, then you're going to average those out, and $9.50 will be the cost basis for those inherited shares. So if you inherit stock, your basis will depend on whether the decedent died before 2010 or after 2009, and in this case after 2010 as well. Your basis when you sell the stock will be calculated using the same rules shown on page 4 of this manual under property that you inherited. The valuation date is chosen by the state, and you must use whichever valuation method was selected by the state. And you can determine the fair market value of stock on a particular date if you have all of the information I just showed you under gifted stock. You punch that into big charts. As long as it's within the last 10 years that the person died, then that works. And if it is farther out than 10 years, you're going to have to either cough up some money or have your client do some research on their own. But most of the time, big charts gives me what I want. Stock acquired at divorce. If you acquire stock pursuant to a divorce, your basis is the same as your former spouse's basis. You should use your former spouse's purchase date and purchase price to determine your basis. And now we're on to the big one, stock options, the one that makes most tax preparers wring their hair. Why doesn't this make sense? So when I finish with the lecture today, it's likely going to be the case that you're still a little confused on stock options. And all I can say about it is if you sit there and you puzzle through it enough and you add the numbers enough, it'll eventually come together and make sense. And then if you work in a tax firm that regularly sees tax clients who have ESPPs and NQOs, you're going to actually get to be quite good at it if you do enough of it. But this is rather a new topic, and we're also at the top of the hour, so I'd say we're due for our next break, and I'm also going to give you another password. More questions. Harvey asks, does the taxpayer need to notify the broker which shares are being sold if, say, you own 1,000 shares and sell 200 when purchases of 1,000 shares were at different times? Well, there's different methods that you can use for allocating which shares are being purchased and which are being sold. You can have first in, first out. You can have average cost. You can have last in, first out. There's different methods that you can use, but it is possible to specifically identify the shares that you want to say you've sold. You could certainly communicate that with your broker, that I wish to sell this lot of shares that has the higher basis so I realize less gain. You could make that decision. Or it could be you want to sell the shares that have a higher basis so you can realize more gain. Maybe you've got some other losses you want to offset. So you can do those things, yes. Waxwing, W-A-X-W-I-N-G, waxwing. Welcome back to class, everyone. Our break is coming to an end, and I'm going to get on with the next part of today's class, which is employee stock options. To begin, the first thing you need to understand is there's different kinds of stock options. And the rules for each type of stock option are different. Firstly, we have the incentive stock option. You could say that this is the original stock option. And these were really popular in the 1990s, part of the dot-com era, when everyone was investing in high-tech this, high-tech that, software companies. These were really, really popular. And a lot of it went on in the 90s. And then what happened is we went from dot-com to what they called dot-gone. So many of these high-tech companies were going out of business, and a lot of people were holding stocks that they'd acquired through incentive stock option plans, and it wasn't a pretty picture for them. The next type we have is the Employee Stock Purchase Plan, or ESPP. It's terribly common. I have clients from all different kinds of companies who are involved in ESPP plans, and they range everywhere from Intel and Nike all the way over to Walmart, where you can have a cashier at Walmart who is involved in an ESPP. So they're across the board in all different industries. Then we have something called a non-statutory, non-qualified stock option, also referred to as an NQO. And NQOs are not as common, at least from what I'm seeing, as ESPPs, but they're definitely more common than ISOs. Now, both ISOs and ESPPs can be statutory stock options. There are two kinds of statutory stock options, and those are what they are. The incentive stock options, or ISOs, and the ESPPs, employee stock purchase plans. Between them, ISOs are relatively uncommon these days when compared to the non-statutory, non-qualified stock options, or the NQOs, and the ESPPs. And employees who purchase and sell statutory stock options may receive special tax treatment depending on whether they met particular holding periods. These holding periods are really important. You have to cement them in your head, and once you have those cemented in your head, you really have a fundamental beginning to understand how the rules apply to basis of assets. To qualify for special tax treatment, which is the whole reason people acquire stock through ESPPs and ISOs, is to receive special treatment under the rules for statutory stock options. And in order to get that special treatment, both of the following rules must be met, or both of the following situations must be true. You must be an employee of a company or a related company that's granting you the option from the time it is granted until 3 months before you exercise the option, and the option must be non-transferable except at death. We're going to look at incentive stock options first. If you received a statutory stock option, you do not include the value of the option in your income when that option is exercised or when you receive it, or basically when it's granted or when you exercise it. Note, however, that even though the option is not income to you at the time you exercise it under the regular tax, it is taxable income to you under the alternative minimum tax. Generally, you will report any gain from the sale of an ISO stock on Schedule D, and your basis in the ISO stock is the amount that you paid for the stock when you exercised your option to buy. Your holding period for the ISO stock begins on the day you exercise your option and acquire the stock. Now, if you purchased ISOs, you would typically receive a Form 3921 from your employer, in which show you the date the option was granted, the date the option was exercised, the exercise price per share, the fair market value per share on the exercise date, and the number of shares transferred. This information is important because you would use it to figure any additions to income that you need to report on Form 6251 so that you can pay alternative minimum tax. But also, when it comes time to sell that stock, you will use the information on this form for figuring your basis. There are some required holding periods if you receive an ISO, and the whole point of receiving an ISO, exercising a grant for an ISO, and then holding on to it, is to get this special tax treatment. But to receive the special tax treatment, which is essentially that the income that you receive from the exercise of this stock is only going to be taxed to you as capital gain income rather than as wage income, you have to meet these holding periods. And the holding periods are that you must hold the stock at least 1 year from the exercise date and at least 2 years from the grant date. And I've got examples coming up of how that would work. If you do not meet the required holding periods, both of those holding periods, more than 2 years from the grant date, more than 1 year from the exercise date, if you don't meet those rules, and then you sell the stock within either of those two time frames, then the difference between what you pay for the stock and what it was worth on the dates that you exercised, that has to be bumped up on your W-2 and reported as wage income. So here's an example of how we would work with a qualifying ISO sale. Your employer granted you an incentive stock option on July 13, 2010 to buy 100 shares of Mega Corporation stock at $20 a share. You exercised the stock or purchased the stock, because that's what exercise means, on January 1, 2011 for $20 a share, when the fair market value of the stock was $30 a share. So you're granted the right to buy at 20, you exercise at 20. Your cost is 20. If you hold the stock at least 2 years from the grant point and at least 1 year from the exercise point. So if you then turn around and sell the stock at $35 a share, you're going to have a gain, which is going to be 20 from 35, or $15 per share, because you meet the holding periods. So the share quantity is 100. We have the grant date, and we're just looking here to see 7/13/2010. What's the exercise date? 1/10 of 2011. We want to make sure this sales date is more than 1 year after the exercise date and more than 2 years after the grant date. And we can see in this case that that is true. So the grant price will therefore be and the same as the exercise price in this situation, and the exercise price becomes the cost basis. Because you held the stock for more than a year and you sold the stock at least 2 years after receiving the stock option grant, you report your gain or loss as a capital gain or loss. The selling price is $2,500. The purchase price is $2,000. That means you have a $1,500 gain. None of that gain is taxable to you as wage income. You're going to report it all on Schedule D using Form 8949. Now, for alternative minimum tax purposes, you would have a different basis, and under AMT rules, your basis would actually be $30. And we'll show you why as we move through the class today. And I even have an illustration here. I forgot I'd done it. The difference between the grant price and the fair market value on the date of the sale is income under the rules for AMT. So in this illustration, the basis under AMT is $3,000, that's $30 per share. And therefore, the gain under AMT will only be $1,000 when the stock is sold, rather than the $1,500. Now here's an example of a disqualifying ISO sale. Your employer granted you an incentive stock option on July 13, 2010 to buy 100 shares of Mega Corporation stock at $20 a share. You exercised the stock on January 10, 2011 for $20 a share when it was trading at $30 per share. And then on April 23, 2012, you sold the stock for $35 a share. Well, even though you sold the stock more than 1 year after you acquired it, you sold it within 2 years of the grant date, and therefore it becomes a disqualifying disposition and basically turns it into an NQO. And what happens is the difference between the fair market value of that stock on the grant date and the exercise price, we have the grant price, we have the fair market value on the grant date, the exercise date. The difference between that and what you actually pay for it is $10. And that $10 spread is included in your income on your W-2 as wage. And therefore, your basis moves to $30. And if you sell it at $35, you have a $5 profit per share. So we have a selling price here, $35 times 100 shares is $3,500. A purchase price of 20 times 100 shares is $2,000. We have a gain of $1,500, but the way that gain is going to get taxed is $1,000 is going to add to the wage income and is reported on the W-2 as wages, and only $500 becomes capital gain. Employee stock option and stock purchase plans, or ESPPs. And as I said, these are pretty common these days. Employees who exercise stock option rights or participate in ESPPs are usually very confused and don't know how to report income from the sale of their stock or how to calculate their basis in options that they exercise. That's why they come see me. That's why they come to our firm. They don't know what to do. Now, sometimes they take their best guess at it. Sometimes they go off the 1099B they've received. But I'm seeing that 1099Bs are wrong and cannot be relied upon. I see some that are perfect. They're absolutely perfect, and I see other 1099Bs that are absolutely wrong. So it's important to understand what the rules are so that whenever your client comes in and you can see that they sold ESPPs, that you are able to verify that the reporting on the 1099B is correct. And we look at some illustrations of 1099Bs and how to figure the gain or loss on those stock option sales in our course called Sale of Assets. I don't really do a lot of it today in terms of how they transfer over to the Schedule D. We don't analyze brokerage statements here today. That's all coming up in our class next week. But what I will do today is just explain the rules to you so that next week, if you come back for Sale of Assets, you'll see how it all applies when we look at the forms. So in the case of ISOs, the IRS issues Form 3921. But in the case of ESPPs, the IRS issues Form 3922. 3922 essentially provides all of the same types of information: the date option granted, the date option exercised, the fair market value on the grant date, the fair market value on the exercise date, exercise price. Well, exercise price, you might think that that's your cost, but really, whenever you're dealing with ESPPs, there should be a gross up happening on the W-2. The gross up will either be the difference between the exercise price and the fair market value, or it'll be the fair market value on the exercise date. So there's the fair market value on the grant date, there's the fair market value on the exercise date, and then there's the exercise price paid. And the basis could be either 3 or 4. Actually, it could be 5, but it could also be 3 or 4. So it depends on how long they hold it and all of the different things that happen in terms of holding period as to what ultimately happens with the stock. And all in all, it means you just have to slow down, analyze the dates, analyze the rules, and apply them. Now, if you have an employee who is issued a 3922 by the employer because they did exercise incentive stock options or because they did exercise ESPPs, the employer is supposed to give them additional information that they should be using to report their basis. Now, the thing is, many employees don't understand what they have received. The employer will give them information at the time they exercise, the information that may or may not make sense to them. If it doesn't make sense to them, it could be that they file it away in a drawer and forget about it. It could be that they put it with their tax statements. It could be they have no idea what it is and they just shred it or throw it out. And so I find as a tax practitioner that very often when I'm asking for the very types of records that the law says their employer should provide to a worker, that worker is saying, I have no idea what you're talking about. They never gave me anything. And I've even sent workers to their employers and saying, okay, there was an exercise of ESPPs. We need to get the cost basis information. And supervisors over that employee don't know what they're talking about either. But at some point, if you go high up in the chain, there should be someone who gets it. And I've really had arguments over years with clients insisting that they get this document, that the document is there if they'd only look for it. And very often after a lot of poking and prodding, they're able to bring me what I'm asking for. But some people just are unwilling, and so in the end, it becomes an effort in frustration. But let's see what it is I'm trying to accomplish and why. It all happens when we end up selling an ESPP. And the rule for ESPPs, and just in general, going back to earlier when I said, when you receive an asset or service or a product from your employer in exchange for services, the value of what you've received has to be added into your income and reported as wage. Well, the IRS has a provision for ESPPs that a certain amount is reported in wage if the holding period requirements are met. And then a different amount is included in wage if the holding requirements are not met. So again, those holding requirements being 2 years from the grant date, more than 1 year from the exercise date. So if we meet both of those tests, then how income is reported on the W-2 of the employee is going to differ. Now, some of my clients purchase ESPPs and then sell them the same day. And the reason they do that is usually they're given a discount. Say the trade price of the stock is $100 a share, but they're able to buy it at $85 a share. They have a right to exercise 100 shares, so they exercise and sell all 100 shares within minutes. Their W-2 is immediately grossed up by the difference between the fair market value on the exercise date and the purchase price, and it's added to their wage income, and then their basis becomes the fair market value on the date of the exercise. So why is that the case? We'll go through and show you some illustrations. If the special holding period requirements described below are met, the sale of stock is generally treated as a capital gain or loss. However, you may have compensation or wage income if the option price of the stock was below the stock's fair market value at the time the option was granted, or you did not meet both of the holding period requirements. And again, those holding period requirements are 2 and 1, 2 years from the option grant date and more than 1 year from the time the stock was transferred to you. In other words, the exercise date. If you do not meet both of these holding period requirements, there is a disqualifying disposition of the stock. It would probably be safe to assume that the vast majority of dispositions of ESPPs and ISOs are non-qualifying or disqualifying dispositions. There's only a small handful that I see in any tax season that are qualifying. So it's important to pay attention to the rules for qualifying and non-qualifying, but you should always be working from an assumption that they're probably non-qualifying until you establish in your mind that the 1 year test and the 2 year test have both been met. Now, if the holding period requirements are not met, then your employer should report compensation or wage income in box 1 of your Form W-2 for the year of the disqualifying disposition. The amount to be reported as compensation income is the excess of the fair market value of the stock on the date that stock was transferred to you over the amount that you paid for the shares. If the holding period requirements are met and the option exercise price is below the fair market value of the stock at the time it was granted, you report the discount as compensation wage income when you sell the stock, and generally this compensation is the lesser of the excess of the fair market value of the stock on the date of the disposition over the exercise price, or the excess of the fair market value of the stock at the time the option was granted over the exercise price. If the holding period requirements are met and your gain is more than the amount reported as compensation income, then the remainder gets to be capital gain. And so the law is automatically with ESPPs pretty much always going to say there's a certain amount of wage income, because the whole point of ESPPs is you're purchasing them at a discount. And since you have wage income involved with the purchase of ESPPs, you typically are always going to be grossing up or adding to the basis of the ESPP at some point. It's possible that it wouldn't happen, but most of the time it does happen. And then if the ESPP goes up in value again from the time you exercise it, then from the point you exercise to the point you sell, then you would have capital gain as long as you held it long term. So calculating basis in ESPP shares, for an ESPP option granted at a discount, your basis is the amount you paid for the stock plus any amount that you included in your income as wages. This amount is the lesser of the discount based on the beginning of the offering period or the profit when you sold the shares. So in other words, it could be that the discount you received is a really good discount, but then after you purchased the stock, it decreased in value. And so your gain is going to not be as much. So you would look at your profit and you would look at the difference and you go with the lesser amount. Example, qualifying ESPP sale. What is an NQO, Nancy? An NQO is a non-qualified option. It's essentially an ISO that was not held for the required reporting period. So a non-qualifying option is an ISO, incentive stock option, that was not held for the required 2 years plus 1 year. And it automatically becomes a disqualifying option or an NQO. So here's an example of a qualifying ESPP, and we'll see the subtle differences between a qualifying ESPP and a non-qualifying ESPP. Your employer granted you an option under its ESPP on April 15, 2010 to buy 100 shares of Mega Corporation at $20 a share. And by the way, as I'm getting into this problem, I wanted to tell you that this is actually numbers that I pulled off of documentation brought to me by a real client about a decade ago. I didn't make these up and pull them out of my hat. I haven't copied them from anywhere else. They really did belong to a real tax return that I prepared for a client. And the beauty of working with clients who have these ESPPs and these NQOs and these ISOs is that if you understand the rules, you eventually are able to puzzle everything together. If you get a copy of their pay stub for the point in time where they exercised options, if you get a year-end pay stub that might contain that information, if you get any other documentation provided to them by their employer, and you have the 1099-B statements, it all does come together. If you get it, it does come together. And in this illustration, all of the numbers I've given you exactly coincided with documentation brought to me by my client. So I turned it into a problem for teaching my students. So back again, your employer granted you an option under its ESPP on April 19, 2010 to buy 100 shares of Mega Corporation stock at $20 a share. Mega Corporation stock was worth $22 a share when the option was granted. So at the time you received the grant, your employer is saying, I'm going to allow you to purchase stock for $20 a share, even though at this point in time it's trading for $22 a share. And then you wait a period of time before you finally exercise. And by the time you exercise, the value is now $23 a share. So on December 23, 2012, you then sell for $30 a share. It's been a good stock. It's kept going up in value. And ultimately, you only have to pay $20 for something that you sell for $30. Because you held the stock for more than a year and you sold the stock at least 2 years after receiving the ESPP stock option grant, you have a qualifying sale. You must report the difference between the option price, $20, and the fair market value at grant date, $22, as wage. The rest of your gain is capital gain, calculated as follows. You take the selling price of 30 times 100 shares, and that's your sales proceeds, $3,000. You then take what you paid for the stock, $20 times 100 shares, $2,000. So your gain is $1,000. But tax law says if your boss, your employer, sells you something for less than it's worth, that difference is income to you. And that difference or spread was $2 a share. 200 times 100 is $200. So your employer adds $200 to box 1 of your W-2, and you have to pay tax on it. And now that you've paid tax on $200, your basis is $2,200, which means your profit on the sale that you can report as capital gain will be $800. So I put that information into this table, and I'm going to show you the same exact illustration again in just a moment with a subtle change that changes what boxes we're looking at. So in the qualified disposition of ESPP shares, we look at the fair market value on the grant date, we look at the exercise price, and we look at the sales price. And we're going to take the spread, which is the difference between the fair market value on the grant date and the exercise price. Spread, it becomes wage income. And then the difference between that, $22.30, is capital gain income. Now let's look at a disqualifying ESPP sale and see the difference. Your employer granted you an option under its ESPP plan on April 19, 2010 to buy 100 shares of Mega Corporation stock at $20 a share. Mega Corporation stock was worth $22 a share when the option was granted. Sounding similar, isn't it? You exercised the stock on October 10, 2011 for $20 a share. At that time, the stock was trading at $23 a share. And then on April 23, 2012, you sold the stock for $30 a share. Well, let's look at these dates again. We have a grant date of 4/19 of 10, an exercise date of 10/10 of 11, and a sales date of 4/23 of 12. Well, 4/23 of 12 is less than a year after the exercise date, even though it's more than 2 years after the grant date. This is a disqualifying disposition, and because it's disqualifying, we don't get to consider the fair market value on the grant date in figuring the amount of wage income. Instead, we go to the exercise price of $20, we look at the fair market value on the exercise date. It's a $3 spread, and that means the amount of wage income the employer has to include on your W-2 is going to be $300 instead of $200. The sales price is still $3,000, the purchase price is still $2,000, and the gain is still $1,000. But $300 of that gain has already been included in your wage as income. Therefore, your basis bumps from $2,000 to $2,300, and you end up with a capital gain of $700. So since this is a disqualifying disposition, we're going to have to include $300 in wage income instead of only $200. Now, where do these rules come from? Where are they spelled out? I already explained earlier today that you could go read Publication 15B, but these rules, precisely as I've covered them in class, are covered on page 11 of the Employer's Tax Guide to Fringe Benefits. Who reads Publication 15B? Publication 15B is read by employers. It should be understood by employers or the payroll departments as they're figuring out how much to report on the W-2s of their employees. And what it says is, it instructs the employer to include in Box 1 of Form W-2 the discount given to an employee on stock acquired by the employee through an employee stock purchase plan when the stock is sold or disposed of, and the spread or difference between the exercise price and the fair market value of the stock at the time of the exercise given in a disqualifying sale or disposition of stock acquired by an employee through the exercise of an incentive stock option or employee stock purchase plan option. So non-qualified stock options and disqualified ESPPs. Because many employees sell their stock as soon as they are purchased, the most common types of transactions seen are the sales of non-qualified options, NQOs, and disqualifying sales of ESPP shares. The calculation of basis is the same for both of these types of transactions. However, they are reflected differently on the W-2. As an employee of a company, your net income from the sale of shares acquired from NQOs and ESPPs is generally treated as wage income as follows. If your NQO plan allows you to purchase stock at less than its fair market value, then the difference between the fair market value of the stock on the day you purchase it from your company and what you actually paid for it must be included in your income as wages, and it is included in Box 1, 3, and 5. In other words, it's subject to Social Security and Medicare tax. And then the employer must further identify that NQO exercise with a code V in Box 12 of the W-2. So anytime you're holding a W-2 and you see a code V in Box 12 with a number next to it, that's telling you that your client exercised non-qualified options. That's what it means. Now, by contrast, if you sell your ESPP shares before the holding period is over, then the difference between the fair market value of the stock on the day you purchase it from your company and what you actually sell it for must be included in your income as wages. And this amount is only included in Box 1 and is not identified on the W-2, with a code V, that is. Because an employee can have income from the sale of NQOs and ESPPs in the same year, the following illustrations include both. And again, this is real numbers that I had from a real client. It was a nice tax return to prepare that year. Everything came together nicely. All the substantiation was there. And when I was done, we had a tax return that we filed a Schedule D for that looked exactly like the numbers on this page. Of course, everything's been fictionalized and the names are changed for client confidentiality, but the calculations that went into it are what's important. We have a tech employee Our character in the story is named Tech Employee, and he purchased and sold shares through his ESPP plan as follows. On February 19, he bought and sold 199 shares through his ESPP for $21.26 per share, or for a sum total of $4,231 and change. On February 19, the fair market value of those shares was actually $30.475, or $6,064.53. So the difference between what he paid, $42.31, and what they were worth, $6,064, is his spread. Then on August 19, he bought and sold 82 more shares through his ESPP at $18.705 per share, or $1,533.81. And at that time, the fair market value of the shares on August 19 was actually $22, meaning that the fair market value of the shares he acquired was $1,804.41. We're going to calculate Tech Employee's basis in his ESPP shares as follows. We look at each date and the number of shares purchased on each date, and the amount that he pays for those shares. We look at the difference in those shares, what should be included in his income. So we're going to take $6,064, subtract from that what he actually paid, and we get a difference. $1,833 for the February 19 purchase of 199 shares, and $270.60 for the August 19 purchase of 82 shares. So if you take those two numbers, $1,833 and $270, you add those together, you get $2,103.79. And Tech Company must include that amount, $2,103.79, in Box 1 of Tech Employee's W-2. And then he will report that income on his Form 1040 Line 7 as wage income. We're going to calculate Tech's cost basis in his shares as follows. We look at the quantity of shares purchased, the amount he paid for those shares, the amount that was added to his wage income, and you get his cost basis. And we do the same thing for the second set of 82 shares. So that's his ESPPs. But this same employee in the same year also has ISO purchases. So on March 3, Tech exercised an option to buy and sell 999 ISO shares as follows. 359 shares at 20.23 per share, which totaled $72.62 and 57. And then he also purchased another 640 shares at 19 per share for a total of $12,160. So 359 plus 640 is 999 shares, and his total cost in those shares that he had to pay for them is $19,422 and 57 cents. Now, at that time, the fair market value of those shares was actually $30 per share, $29,970. So he has a nice discount there. And I've totaled those up here. You can see March 3, the 999 shares. The amount he paid is $19,422. The fair market value on the purchase date is $29,970. The spread or difference is $10,547. Then on June 7, Tech exercised an option to buy and sell 1,275 ISO shares as follows. 262 shares were 18.63 per share for $48.81, and then there was another 1,013 shares purchased at 20.74 for a total cost of $21,011. The total cost of all 1,275 shares is $25,893, and at that time, the fair market value of those shares was actually $36,377. So we're going to take $25,893, subtract that from $36,337, and we have his difference, or his spread, $10,444. And because he has a spread there, and because it's a disqualifying disposition, Tech Company must include $20,991.92 as wage income in boxes 1, 3, and 5 of his W-2. Because this is an ISO. ESPPs, they don't report them in boxes 3 and 5. They only report it in box 1. But with ISOs, it goes in all 3 boxes. So we take $10,547, we add $10,444, we get $20,991.92, and where would I be looking to see that number on his W-2? Any guesses? By now you must have spun off and probably not hear half of what I'm saying, but this number, $20,991.92, is going to appear in one specific box, or is required to be reported in one specific box on his W-2. And the answer is, it's box 12 with a code V. This is the number that should be on the W-2 with a code V next to it. So I see Keith asks, when some of the income is reported as wages, do you have to pay FICA taxes on it? Well, the answer is it depends on if it's an ESPP or an ISO. If it's an ISO non-qualifying option, NQO, then it is subject to the payroll taxes, the FICA taxes. which is this illustration right here. We've got the March 3 and the June 7 exercises. That income, $20,991, is added to boxes 1, 3, and 5 because it's subject to FICA. But in the earlier exercise where we were dealing with ESPPs, we only add the $2,100 spread to box 1 and not boxes 3 and 5 of the W-2. So let's take a look at the W-2. And here we have the 999 shares exercised under the NQOs. We also have the 1,275 shares exercised. We have the amount paid for the shares, we have the amount added to income for the shares, and then we have the total cost basis in each of those shares. So if we take 10,547, we add 10,444, we take those two numbers, and I've got them down on this chart right here in pink. You can see the total is $20,991.92. And we've rounded that up on the W-2. It's $20,992. So that's exactly the way it's supposed to look. That's the correct way to report it. And this $20,992 is included in box 1, it's included in box 3, and it's also included in box 5. But we have to pay attention to some other numbers that are on here. We have a box 12 with a code C, $58, box 12 with a code D of $77.97. Those are both salary reduction items. So this amount, 58, and this amount, 77.97, have been subtracted from box 1. So if you take 76,121, however, you don't get the difference. Like if you take 76,121 and subtract out 77.97, you have a number that's less than 70. So that tells you something's weird's going on. Let's look at this down over here to see what happened. Verification that the ESPP discount of $2,103.79 was added to box 1 is calculated and shown right here. We take box 3 wages of $76,121. We subtract out the $77.9660, which is this number before rounding, and we get $68,324. We add in the ESPP amount, and we have $70,428. And that is the amount in box 1. So those are the types of things we're looking to balance when we look at a W-2. We want to see that the numbers make sense. And in this case, they all add up splendidly. Now, of course, there's going to be a sale document coming in somewhere, and there should be a 1099-B coming. Now, when it comes to non-qualifying options where the employer has properly reported the gain on the sale in box 12 with the code V, IRS instructions specifically state that the employer is not required to show that sale on a 1099-B. However, I find about 60 to 70% of the time a 1099-B is still issued. So you should be looking for the 1099-B and trying to establish whether or not one is issued. And the complexity is they're not required to issue it. But if they do issue it, then you still have to report the sale on 8949, or your client will get a bill because they didn't report the sale. So it's kind of annoying that there is that problem. The IRS used to always require that they be reported on a 1099-B, but about a decade ago they changed the rule and said you only have to report on a 1099-B if it's not properly recorded in box 12 with the code V. And since then, we've got a situation where most employers still report it on a 1099-B, but a few employers don't report it because they're not required to, and we have to kind of figure out what's what. Now recently, this year, in fact, I had a client come to me. I had prepared their tax return for the past several years, and each and every year I asked them, did you sell any stock during the year? And the answer was always no, and I could look at the W-2 and I might be able to see that there was a code V on there, and then I'd say, did you get a 1099-B? And they'd tell me no. And I'd say, well, are you sure? Can you go check? And they'll say, nothing's come. I know I don't have anything. Well, go forward in time about 18 months, and they've got this letter from the IRS saying you didn't report the stock sale. So I'm getting a phone call. My client's all hyper because I left something off their tax return. Well, why didn't you bring me the 1099-B? Well, the reason they often don't bring me the 1099-B is because it's not even mailed to them. They have to log in to an account, usually through their employer, to get their year-end tax statements. And if they didn't log into their account to get their tax statements, then they never realized they had the 1099-B. So often my clients have to live through that experience of getting the nasty-gram from IRS before they start to take what I say seriously. But since I know as a fact that about 60 to 70% of employers who report ISO transactions or NQO transactions in box 12 with the code V are still going to issue a 1099-B, I'm really trying to run home to my client or drill into my client that there probably is a document there. But the dilemma is very often there's not, and I don't know when there's going to be a difference. All right, so here is the next part of this same illustration involving tech employee. He received a 1099-B, Reporting the sale of each of his ESPP option exercises and the NQO shares completed Schedule D as follows. So we can see the $199, the $999, the $1275, and the $82. We can show the sales proceeds, less commissions. We see the cost basis, and you can see here the cost basis is a little bit higher than the gross proceeds. And then we have the type of gain or loss being reported, which is short term, and that should be correct. Ultimately, we see the $74,176 carried down here, and we're dollar off just because of rounding in the computer. And then we have $73,953 being carried down here as our sales proceeds, and we end up with a slight loss. And that's normal. If you're reporting the sale of non-qualified options or non-qualified ESPPs, you should be looking for a loss, because usually they're going to report the difference between fair market value on the exercise date and the price they pay as wage income. So that fair market value becomes their cost. And then when they sell it, presumably they're selling it for fair market value, but they have to pay brokerage fees. And those brokerage fees add to their cost and reduce their profit and produce a small loss. So it's normal to see a small loss. You should expect that. I've also seen profit because, if you have trade enough shares and the market is pretty active, even if they only hold them for a few minutes or a couple of hours, the stock could rise in value and they could end up with a gain. I have seen that happen, but nearly always it's really a loss. So here's the $89.49 for a tech employee. Each of these trades has to be properly reported, which we've done. And then, of course, the net income carries to the Schedule D. Cashless transactions, this is one of the things you need to remember about ESPPs and NQOs, is that they're virtually always cashless to the employee. The employee simply says, yeah, I want to exercise the options. It's all done through the payroll department. People are communicating with the brokerage houses, and it's done. And the employee never is involved beyond that. And because it looks like that, very often they're not really aware of all the transactions that are going on, how they're going on, or why they're going on. Ultimately, what they're interested in is how much bigger paycheck they're going to get as a result of that exercise, because the profit that they have from the sale is going to bump up their payroll. It's also going to bump up their withholdings. Most employees exercise and sell their options in cashless transaction. In a cashless transaction, the stock is exercised and sold without the employee ever actually physically paying for the stock directly. The net income from the sale of the stock is added to the employee's wage and then is reported on his or her W-2. Social Security, Medicare, and withholding taxes are deducted as required. With ESPPs, they are not. The Social Security and Medicare is not withheld, but with NQOs, it is withheld. Employees who exercise and sell their stock options in a cashless transaction do not have to report the sale of stock on Schedule D and Form 8949 when their employer properly reports the income on their W-2. And then puts a code V. However, if an employee still receives a 1099-B, then they're still going to need to report the income on Form 8949. And here's part 3 of our illustration. When you have a client who has had these stock options going on, the ESPPs and the NQOs, seeing their year-end pay stub, the last pay stub they get at the very end of the year, will often show you the information that you're looking for, because that year-end pay stub should show a breakdown of all of the income amounts that were put in that employee's income for the year. And here we have an illustration of what tech employees' W-2 looks like. We have a base salary of $53,000. He also received sick pay, vacation pay. Oh, what's this? An RSU? Well, he received some RSUs, and they bumped up his payroll by that amount. He has ESPP income. He has NQO income. And look at these two numbers. They match the numbers that we've already been looking at in the earlier parts of our illustration. So we get the total amount of income, $78,224.86. But that's not the amount reported on the W-2 in Box 1, because we're going to subtract out the 401k contribution. And ultimately, when we do that, we get $70,428. And then Box 3, of course, does not include this number, $2,103. And so it is down to $76,121. And when I'm able to see all of those numbers come together, I've got the 1099-B, I've got the W-2, I've got the final pay stub. If I'm able to put all of those pieces of information together, I should be able to solve this puzzle. I'm going to go in a little bit now and talk about some other types of stock awards that employees are given. The first one I'm going to talk about is something called an RSA, or Restricted Stock Award. These are quite rare, but I do have one client who has received these. Restricted stock awards are a method by which companies reward employees with stock but retain the right to force the return of the stock if the employee does not meet certain preset requirements. With RSAs, a company awards an employee a number of shares of the company's stock subject to vesting restrictions, such as the requirement the employee remain at the company for 1 year before the awards vest. Important RSA facts include that the employee becomes the owner of the shares before they are vested and is entitled to vote and receive dividends on those shares. Then if the shares don't vest, the company has the right to cancel the award. The vesting of RSAs typically creates a taxable event for the employee who must either provide outside cash to the employer to pay taxes that need to be paid to the IRS through payroll, or sell some stock back to the company or on the open market, and then the employee will own the remaining shares. Note that the company will often gross up wages with additional compensation to cover the tax consequences. The employee's interest in RSAs are aligned with other shareholders. When the company's stock goes down, the employee suffers along with other shareholders. Let's compare that with RSUs. RSUs are completely different than RSAs. They're a similar concept, but they work differently, and they're quite common. I'm seeing those all over the place. Restricted stock units, or RSUs, are a form of compensation used by companies to reward employees who provide certain services or reach certain milestones. RSUs have increased in popularity in recent years as many companies move away from stock options, those ISOs and NQOs, in favor of RSUs. An employee who is awarded RSUs obtains a right to receive shares of stock when the RSUs become vested. And upon vesting, the company issues the shares and the recipient becomes the shareholder. But again, if you've just received stock from your employer in exchange for your services, now you've got payroll, don't you? And the rule is that they include fair market value of all of the stocks that they give you in your income, and you pay tax on it. And usually, if they're giving you $10,000 worth of stock, you're going to have to pay tax on that $10,000. And you may not have the income or the money on hand to pay that tax. So what very often happens is the employer will include $10,000 in your income because they gave you $10,000 worth of shares, but then they're going to sell off enough shares to pay the tax on the shares, and you're left holding remaining balance of shares. Until an RSU becomes substantially vested, it is not owned by you and continues to be the property of your employer. When the property becomes substantially vested, you must include its fair market value, minus any amount you paid for it in your income for that year. Your holding period for this property begins when the property becomes substantially vested. So when do RSUs vest? Well, it depends on your company's plan rules. Vesting requirements may be met by either the passage of time or company or employee performance. If an employee does not meet the requirements set forth by the employer prior to the end of the vesting period, the units are typically forfeited to the company. Some companies may allow vesting prior to the vesting date, contingent upon company satisfaction that an employee has complied with certain criteria that the company has set out, and other times it's just based on the amount of time. So what happens to RSUs when they vest? Well, once RSUs vest, an employee's rights to the vested stock become non-forfeitable. At vesting, the employee will receive the actual payment according to the distribution schedule under the company's plan, and in some cases, an employee may elect to defer the distribution. If an employee does not elect to defer the distribution, then the distribution date and the vesting date are the same. So here's a couple of illustrations I put together for you on how tax payments can be paid. The employee essentially has two options. Once the shares are vested, how are the taxes paid? Well, depending on the plan rule for the company, there are usually two options which can be used. There's the net share, which is the most common, but there's also the pay cash option. Under the net share option, an employee who elects to net shares will sell enough shares to the employer or have the employer withhold enough shares to pay the taxes on the withholding obligations. Under the pay cash amount, the employee keeps all of the shares vested and then brings money from their pocket to pay the tax they're going to owe on that award. So here is an example of how the net share would work. Ralph had 100 RSUs vested to him by his employer on April 1st. And at that time, the market price of the stock was $60. His combined income tax and payroll withholding rate is 40%. Ralph's employer will include the following income on his W-2. 100 shares times $60 or $6,000. Ralph's employer then sells 40 shares to pay tax withholding on taxes Ralph owes on the RSUs. So 40 shares at $60 a share are sold $2,400 of tax is paid out through his payroll. Well, since they sold 40 shares, he's left holding 60 shares. And what's his cost in each share of the remaining 60 shares? It's going to be $60. So his basis in all of the shares he's still left holding is $3,600. So when you have a client that comes to you and they've just sold RSUs, and you're going, well, what's your cost basis? Well, their cost basis in each share that they still have left and that they've just then sold is going to be the fair market value on the vest date. It's that simple. Here's another method where we have pay cash. Sydney had 100 RSUs vested to her by her employer in June of 2012. The market price on that day was $40, and the combined income tax and payroll withholding rate is again 40%. The total amount due at vesting, or the total value of income at vesting, is $4,000, and the total withholdings tax, therefore, would be $1,600. Since she's not deciding to sell the shares to have $1,600 of money paid from the shares she's selling, she's going to bring $1,600 to the table from her pocket and give that to her employer so the employer can then pay the tax. So instead of selling off some of her shares, she has all of the shares left. So in the first example, Ralph nets his shares and he's left with 60 out of 100 shares. And in the second example, Sydney brings cash to the table. So she starts with 100 shares and she ends with 100 shares. Other reporting requirements affecting RSUs. The reporting requirements used by employers can vary. However, most RSU vestings are reported only on the W-2. 1099-Bs are typically not issued to report the portion of RSUs that were withheld to pay withholdings taxes. So earlier in this illustration here, you saw that we have RSUs showing up on here. What that means is that $1,030 of his wage income is attributable to the value of stock given to him. But it doesn't tell you how many shares he received. It doesn't tell you the fair market value of the shares he received. Only that $1,030 was included in his income. So somewhere out there, there should be some records because he was awarded that stock and his income was grossed up. You might have to look at an earlier paycheck to figure that out. You might have to look at other documents to figure out how many shares he was actually awarded. So what happens when RSUs are sold? Well, once they are fully vested, the holding period and capital gain rules for RSUs are the same as for any other form of stock out there. And the short-term and capital gain loss rules apply. How long you hold the shares depends on whether they will be sold for long-term gain treatment or short-term gain treatment. And as long as you hold them more than a year, you would get long-term capital gain treatment. The final topic of the day is dual basis assets. And I did touch on dual basis earlier when I gave you an illustration for alternative minimum tax purposes. There are two reasons why you can have different basis under AMT than you do under the regular tax. The first reason is for depreciation. Depreciation allows for certain rules to be applied to figure out the amount of depreciation deduction you can claim. And under AMT, sometimes different rules are in application. And so what ultimately serves to happen is if AMT provides for a different depreciation deduction than the regular tax, early on it's probably the case that AMT is allowing for less depreciation. So what ultimately happens is that if you sell an asset that was being depreciated more slowly under AMT than it was under the regular tax, your basis under the regular tax is going to be lower than it is under AMT. So here's an example. Billy has been depreciating a computer network, and he paid $20,000 for the network and has claimed depreciation deductions of $12,000 under the regular tax, leaving him with an adjusted basis of $8,000. Now, during that same time, his AMT depreciation deductions for that same computer were $11,000, leaving him with an AMT adjusted basis of $9,000. So his AMT basis is 9, his regular adjusted basis is 8, and that creates a difference in basis for AMT. The other difference comes with incentive stock options. If you have qualifying incentive stock options, the AMT base rate or the AMT cost basis is going to be higher in most cases than the basis under the regular tax. And that's because the difference between the exercise price and the grant price has to be included in income under the rules for AMT, even though it doesn't have to be included in income under the regular tax when you have a qualifying exercise. So here's an example. Billy exercised ISOs in Jack Inc. At the time of the exercise, Jack Inc. stock was trading for $80 per share. Billy exercised an incentive stock option to purchase 500 shares at $30 per share. For alternative minimum tax purposes, he reports an adjustment of $25,000, $50 per share. The result is that his basis in Billy Jack Inc. is $30 per share under the regular tax, but $80 per share for AMT. So what happens when you sell a dual basis asset? Well, the sale of a dual basis asset, such as ISOs or assets affected by AMT depreciation adjustments, makes it necessary to report the difference between the regular tax gain or loss and the AMT gain or loss as an adjustment item on Form 6251. If the AMT basis of an asset is higher, which is usually the case, then the difference is reported as a negative number on 6251. The result may be to reduce the amount of AMT owed or to increase the amount of AMT credit allowed for the year. So here is an illustration of how that works. So here we have it. In the preceding example, Billy held 500 shares of ISO stock with a basis of $30 per share for regular tax purposes and $80 a share for AMT purposes. If he sells the stock for $100 per share and has no capital gains or loss, he should report a negative amount of $50 per share on Form 6251. If Billy is required to pay AMT in the year of sale, this adjustment will reduce his alternative minimum tax liability. If Billy does not have to pay alternative minimum tax in the year of sale, the adjustment may make it possible for him to claim an AMT credit in that year. Well, that's pretty complicated stuff there. Not anything I'm going to talk about in today's class, how to fill out a 6251, how to fill out 8801 for figuring alternative minimum tax and the credit for prior year minimum tax. We have a separate course where I do only that. It's also coming up in July. I'll be doing a 2012 version, but currently you could take a self-paced version with 2011 law. At any rate, I'm going to explain how and why the 6251 and the 8801 are there, because we're going to look at what happens when you have a difference in basis under the regular and AMT rules. We have the same 500 shares of ISO stock, and we have a purchase price under the regular tax that was 15, and we have a purchase price under AMT that is also 15. So the purchase price under both tax systems is the same. But we have a gain on the purchase that is recognized under AMT that's not recognized under the regular tax. So no gain is recognized under regular tax, but a $25,000 gain is recognized under AMT because that's the discount that Billy received. The cost basis under regular tax is therefore 15, but under AMT his cost basis is bumped up to 40. If he sells for 50, he's selling for 50 under both the regular tax and under AMT, so there's no difference. But his gain is very different. Under the regular tax, his gain is $35,000. Under AMT, his gain is only $10,000. So there's a $25,000 adjustment back down again under AMT. And the capital gain or loss to be reported is going to be $35,000 under the regular tax and $10,000 under AMT. There's a question I see that's come up, and it says, how does stock option affect to employer? Well, the effect to the employer is that the employer reports that stock option, the difference between the fair market value of the option and exercise price to the employee. If the employer is able to take a deduction for that, they're taking it as a wage expense deduction. And if they're just selling off stock in the company or giving stock in the company to the employee, if they give the stock to the employee for less than it's worth, then they usually have wage income, except in the case of ISOs that meet the holding requirements, then it's not wage income to the employee. And so the company, how they go about taking a deduction for that would simply be their cost if they had a cost, and they may not have one. All right, illustration number 2. 10/1 of 2010, Sally exercised 1,000 shares of ISO stock with a spread of $60,000. The exercise price was 50 per share, and the fair market value was 110 per share. During the period she held the stock, its value declined to $90 per share. And that actually happened a lot in the dot-gone era. During dot-com days, they were purchasing stock at less than the fair market value, and then they were having to pay a whole bunch of alternative minimum tax under the rules for 6251. And then between the time they paid all that AMT and the time they sold, the stock dropped. So under the regular tax, they had a profit, but under AMT, they had a loss. So during the period she held the shares, the value declined to $90 a share. Sally then sold the stock for a regular tax profit of $40. Under AMT, however, she realizes a loss of $20,000. Now, loss limitations under AMT are the same as they are under the regular tax, and under the regular tax, you're only allowed to claim a loss of $3,000 a year unless you have other income to offset it. So she's only allowed to claim $3,000 of her loss. The difference between Sally's regular tax gain or loss, a gain of $40,000, and her current year allowable AMT gain or loss, a loss of $3,000, is $43,000. She will enter $43,000 as an adjustment to income on Form 6251, line 17. She will also have an AMT capital loss carryforward of $17,000 that she will use in AMT calculations in future years. So here we have the purchase price under the regular tax is $50, and under AMT the same. Under AMT, she had to bump up her income by $60, so there was a difference between the regular tax and the AMT of $60. Her cost basis under regular is $50, but under AMT it's $110. The sales price under both systems is $90,000, and under the regular tax that results in a $40,000 profit, but for AMT it results in a $20,000 loss. The difference between positive $40,000 and negative $20,000 is $60,000. What is she going to be able to do? Well, on her regular return, she's going to report $40,000 of income under the regular tax. Under AMT, she's going to have a $3,000 loss, but the difference between AMT income and regular income is negative $43,000. So she'll actually enter negative $43,000 on the 6251, but her loss is really $60,000, and so she'll have a carry forward to next year of $17,000. So that is the end of the lecture portion of today's class. I do have a classwork assignment on the screen in front of you, but the classwork involves just doing a quick figuring of an ISO sale. We have Seska, who was granted 200 shares of Nistrum stock at $50 a share on 7/13 of 10. She purchases on 1/10 of 11 when they're trading at $60 a share, and then she sells on 8/23 of 2012 for $65 a share. Based on the information presented in classwork assignment number 1 and what you've managed to absorb from today's class in my lecture, what is Seska's basis in her shares? How much will she report as wage income? And how much will she report as capital gain income?
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
Okay, so let's take a look at the dates here. What are the dates that we're looking at? It's a qualifying sale. I made it that simple for you. You should be looking for why it's qualifying. We have a grant date of 7/13 of 10, an exercise date of 1/10 of 11, and a sale date of 8/23 of 12. Well, 8/23 of 12 is more than 2 years after the grant date. It's also more than 1 year after the exercise date. So in this case, we're talking about the regular tax here, not AMT. We're going to have a cost in the shares of $50 per share. And what is her basis going to be? Well, it's going to be 200 times 50. That is her cost in the shares. So 50 times 200 is $10,000. So you should have gotten her cost basis in her shares is $10,000. How much will she report as wage income? Well, since these are ISOs and not ESPPs, and they're qualifying, there's no wage income at all. The answer to number 2 is 0. And finally, how much will she report as capital gain income? Well, if she sells for $65 a share, 200 times 65 is $13,000. If she paid 10 and sells for 13, her capital gain is $3,000. In the second option, we have a non-qualifying ISO sale. Kim is granted 100 Voyager Inc. shares at $40 a share. He exercises on 1/20 of 11 when they are trading at $45 a share, and then he sells the shares on 4/23 of 12 for $70 per share. So we got 4/23. Is that more than 2 years after 7/13? No, it's not. It is more than 1 year after 1/20, but it's not more than 2 years after 7/13. So it's a disqualifying ISO sale. What is his basis going to be? Well, there's going to be a gross up on his W-2, and the gross up is going to be the difference between what he pays for the shares and the fair market value on the date of the exercise. That means that there's going to be a gross up of $5 per share that is going to be added to his income. So his basis for his shares is $45 a share. We're going to multiply that by 100 shares, and we get $4,500. Well, how much is going to be included in his wage income? Well, it's going to be the spread. 5 times $100 is $500 getting reported as wage income. His basis is there $45 a share. If he sells for $70, That means that his gross proceeds from the sale are going to be $7,000. We subtract out $4,500 and we get $2,500. So I have the answer key here for you. I'll put it up, and then this answer key is inside Open Campus for you to peruse. So again, on classwork assignment number 1, the grant is a grant price of $50 multiplied by 200 is $10,000. There is zero amount included in wage income because it's a qualifying exercise. The gain is $3,000 because cost of $10,000 is subtracted from the sales price of $13,000. On example number 2, or classwork number 2, we have a cost basis of $45,000, of which $500 was included in wage income. We sell for $7,000, and we end up with a $2,500 capital gain. Sister Sarah, SISTERSARA. Sister Sarah.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.